we are really, I would say, in much more uncharted territory than markets believe today.
We have seen some incredibly volatile movements in the market. It's likely that we're going to continue to see that as we enter into 2024.
What I do see in 2024 is a more broadening out of performance.
We would say any volatility really provides an opportunity for investors to get involved.
We might actually have a more boring market than you think in 2024.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is the last trading day of 2023. Global shares on track for their best annual performance since 2019. You've got the U.S. market near all-time highs. But, you know, the dollar is poised for its worst year since the onset of the pandemic. You've got oil not doing so well. We got a lot to talk about as we wrap up 2023. A very good morning, everybody, from New York City. For our audiences worldwide, this is Bloomberg Surveillance live on Bloomberg Radio and TV, alongside Manus Cranny and Katie Greifeld. I'm Carol Massar. Guys, pulling up the superlatives this morning, right? There's a lot of them, Manus.
They're just marching out. I mean, just look at the dollar. If you look at dollar and equities, okay, will we get the record high that we've all been baying for? Will we get that one last moment of exuberance in the equity markets? You've got the Dow making multiple record highs in the month of December, but the S&P 500 is still just shy of it. And when you look under the hood of the S&P
47, 96, 56.
Don't forget the 0.56.
For so much?
Almost there.
Almost there.
It would be poetic if we did get it on the final trading day of 2023. Again, you think about this year in totality, all of the sentiment shifts. We started off with a bang in January, almost a year ago. The summer sentiment was pretty bad, I would say, and then here we are.
Don't forget, consensus calls at the start of the year was recession, was China was going to fly to the moon.
Are you reminding all those strategists of what they got wrong?
I got a lot of things wrong in 2023 as well, to be fair. Look, you've got to put your stake in the ground. You've got to try and make a prediction. The question is now, is this exuberance or irrational exuberance that you're seeing in equity markets?
Well, and in a year where we had so much volatility in any given day, to see the VIX now at 12, it's just things have calmed down so much. So what does that tell us, or does it tell us anything?
Yeah, volatility really draining out of the equity market. It feels like it hasn't been a very volatile year. If you take a look at the VIX, the bond market, of course, has been a basket case this year. But I will say, for all those strategists who
getting therapy as we speak,
forecasts that we've been poking fun at. If you think about the Fed story was right. The Fed was more aggressive than expected. The thing that didn't go right for a lot of those strategists is that the economy held up and corporate earnings held up as well. It really didn't make sense if you look at the textbooks.
I think the big risk, if you look at what Bloomberg Economics have put out in terms of their year ahead, what can next year look like? The core PCE inflation accelerating back above 3%. And this is your risk going into 2024. Not so much from the oil markets, but from other commodities. After dipping in the first half of 2024, the Fed will then have to hold rates higher for longer. And that is what this equity market is not discounting.
Well, and then you had AI mania really driving certainly the NASDAQ trade, the tech trade this year, excuse me.
Yeah.
Best run since 1999. We remember that era. So what is the momentum pull coming in 2024, Katie? We don't know.
What's the narrative?
Is there something there?
Will this still be a Fed narrative? Will we start to look at fundamentals? Will it be AI?
You don't think there'll be a Fed narrative? Of course there will be a Fed narrative.
I would imagine there will be, but I feel like we've spoken to a lot of people kind of hoping it into existence.
You just wait for the first couple of weeks of this year,
and
you're going to hear a whole
chart.
new Fed narrative. But this is also, look, they're going to look at the loosening of financial conditions, but also to what extent will they look at this exuberance in equity markets? Because this is the mix that perhaps they don't want as they go into this first quarter.
I feel like the Fed is very good at keeping investors in check, even though they're not supposed to be watching financial markets. That's not their dual mandate. Nonetheless, they know how to smack us down. Let's get to the markets on this final trading day of 2023. S&P 500 futures, you can see, again, little change, man. We've been saying this every morning. 48.34, so up about 2.5. Call it really flat. Looking at the euro dollar, it's going to cost you $1.10 for the euro. So we're seeing just a little bit of a move, but call it pretty mellow here.
Fourth strongest currency against the dollar this year. Swiss franc took it out at a 10% rally. Pound after that at 5%, but the euro came in at number 4 against the dollar this year.
Those expectations, though, of eventual rate cuts, right, certainly putting some pressure on the U.S. currency. U.S. 10-year, let's talk about that, 388. So again, some move to the upside.
Yeah, a quiet rise in yields. It feels like the gravitational pull of 4% is really strong. It's going to be interesting to see how we settle up this year.
May the fours be with you. Or do you take the line? I mean, there was a lovely line on the Bloomberg last night after the 7. I'm Obi-Wan Kenobi.
Listen, I'm just trying to get along.
Where's Darth Vader gone? They got stuffed last night on the 7-year auction. So, not yet last night, but yesterday afternoon. my time lag is still there. They really did. The dealers got left with a lot of paper last night. They just choked. A little bit of indigestion before you went to the year.
We're all tired.
Too much turkey.
I would say we're a little chatty, and I think we all got sleep. I know I got about 14 hours of sleep. Can you tell?
Well done.
All right, let's see how much sleep maybe Sam Stovall got. He's Chief Investment Strategist at CFRA, joining us on this Friday. There is so much to talk about, Sam, as we get ready to wrap up a wild year, one for the textbooks, I feel like, in so many ways. As you sit here on this December, as we get ready for the last trading day here in the United States, how are you thinking about the year that was and the year that might be?
Well, good morning, Carol, and good morning, everybody. I'm basically thinking that looking forward to 2024 also being a good year. History tells us that great years traditionally are followed by good years, that gains in excess of 20% in one calendar year lead to double-digit gains in the second year, basically a 300 basis point improvement over the long-term average with a 10 percentage point increase in the frequency of advance. So basically, you letting your winners ride from one year to the next.
So every day we've got to come up with a new way to ask you whether you want to be long the Mag 7 relative to the breadth of there are 493 other stocks. So find another version of it. If you think you're going to get a double-digit return, the question is then, within Mag 7, they are expected to see their earnings growth rise by 22% next year. That's twice the S&P 500 advance. I mean, there's an irrevocability of having to have Mag 7 as a portion of your equity exposure. So is it still overexposed to Mag 7, or do you go for breadth?
I think you go for breadth, but what you do is you broaden out within those sectors that have done so well. Again, going back to 1990, if you were to be holding on to the 3 best performing sectors from an up year into the new year, you ended up beating the market 70% of the time. And the focus being that now you drift down into the second, maybe third tier level. So semiconductors having 105% improvement on a sub-industry level within the S&P 1500, you would stick with that group, but you might, instead of looking at NVIDIA, you might be looking at Broadcom, you might be looking at Marvell Technology, et cetera. So you stick with the winning sectors, but you might broaden out to the second and third tier companies.
Can I ask you, though, Sam, why not stay with NVIDIA? I feel like, you know what, Manus, if we talk about AI chips, that is still the company that everybody says has to beat. I was listening to something from Ian King overnight. You know, we're waiting for their, accelerator chips that are about to come. I mean, why not go with the leader?
Oh, we still recommend NVIDIA. Angelo Zeno, our tech specialist, is saying that this is a company that is likely to be a leader for quite some time. I think that what I was saying is that we're also going to see others. Maybe we turn it into the Magnificent 14 or so, but we basically broaden out those groups that are likely to benefit.
I mean, it's interesting that you say tier 3, going from NVIDIA 238% performance to Broadcom at 100%. But I get your point. How much exceptional breadth would you take? We caught up with Nat Alliance Bernstein yesterday, and they talked about a sweet spot for junk, a sweet spot for many of these slightly riskier markets. How much risk do you want to put into portfolios next year? How much breadth? I mean, they talk about junk being in a sweet spot. What's the equivalent for you in the equity world?
Well, when you deal with risk, I guess it depends on the individual. I like to say I'm so conservative I wear a belt and suspenders. But I think when you look to historical precedent and you see that we are in an election year for a first-term administration, the market has gained 100% of the time since World War II with an average total return of 15.5%. We're in the second year of a bull market, typically up 12.5%, rising 85% of the time. And as I just mentioned, whenever we're in a year following a 20+% advance, the market has done exceptionally well in that second year. So I would tend to say that if you have added to the risk in this fourth quarter, stick with that higher risk. And if you do believe that there is more risk potential for 2024, I think we're a bit overbought right now. And once we get into the new calendar year, when people can take their profits and then defer taxes for another year, then I would say look to buy on those dips.
Well, let's talk about this from a sector perspective, because you write in your notes that following up years, it's best to let your winners ride. I want to talk about the other side of that. Do you let your losers continue to lose? You take a look at utilities, energy, staples, leading losses this year. Do you just stay away from them in 2024?
Well, obviously, we do have recommendations in all three of those sectors, but from a weighting perspective, we would continue to recommend underweighting these groups, mainly because there's an awful lot of overhead resistance. And if there is the emphasis toward growth, toward risk, et cetera, investors are going to continue to focus on those growth leaders. So I would tend to say that while you could see a drifting higher of some of these groups from a relative strength perspective, they're likely to be underperformers yet.
And I want to get specific here and run through some names, because I'm taking a look at the stocks that you've specified in financials. Charles Schwab. Schwab is a really interesting name to me, because obviously it was one of the babies perhaps thrown out with the bathwater in what we saw with March, and it really hasn't recovered. You take a look at shares down about 16% for 2023. What's the thinking around Charles Schwab at this juncture?
Well, I like to say that fundamentals tell you what, but technicals tell you when and how far. So I like to combine CFRA equity analyst recommendations along with our Lowry Research technical assistance area. So, seeing where the momentum relative strength happens to be. So Charles Schwab, basically, it's an extreme undervaluation situation. It's almost trading at about half of what it normally trades. Also, we're looking at an environment in which the concern, I think, is just totally overblown. So with the prospect of another good year in the marketplace benefiting the investment banks and brokers, one that is oversold and really has not reached its potential is Schwab.
Hey, Sam, our most read story on the Bloomberg, it's a story put together by a bunch of our reporters, and it says Wall Street's best and brightest flopped once again in 2023, basically saying that at the end of 2022, everyone, it seemed, was game planning for the recession they were convinced was coming. There's a lot of things that came out seemingly from nowhere. Regional banking, the concerns there, Russia, Ukraine, that war continuing, and then, of course, the Middle East conflict. As you look ahead, and you obviously have laid out your scenario, what are the things, though, that we must keep on our radar that maybe could just kind of come out of nowhere?
Well, as Manus was saying early on in the program, is when will the Fed start to cut and by how much? Our belief is that they're going to cut 3 times in 2024, starting in the second quarter, mainly because the Fed doesn't want to make the mistakes that they did in the late 70s. They want to ensure that inflation, like a campfire, is fully doused before they start to cut interest rates. So our belief is that only if we end up with a hard landing rather than a soft landing will the Fed be more aggressive from a rate cutting perspective. Also, adding geopolitical issues, should we find that there's a broadening of the Middle East tensions and conflict and the total shutdown of the Red Sea, we still are having some shipping firms that are willing to venture in there, but a total shutdown, a jump in oil prices, those could obviously upend the year ahead forecast.
Yeah, already a full plate, it feels like, for the new year. Hey, Sam, thank you so much. Happy New Year. Always appreciate all the time you give us here at Bloomberg. Sam Stovall over at CFRA. Yeah, full plate. It does feel like as we get ready for the new year.
It's interesting that he said he only sees 3 rate cuts. And again, I think you're going to see a little bit more pushback from the investment community. There's going to be those reasons to be doubtful. 6 was maybe a rational exuberance. The Fed have guided 3, but there's the last voice at 6 a.m. calling 3 rate cuts unless something really bad happens.
First Fed meeting, start of February. It's going to be fascinating to see how pricing changes between now and then.
I think what's interesting is what he said. You got to make sure inflation is doused like a campfire. You got to make sure it's under control.
It's Skype days.
Coming up at 7 a.m., everybody, Brooke May of Evans May Wealth. This is Bloomberg. We're just getting started on this Friday.
This is more complicated because the Houthis are distant. They're inured to war, backed by Iran. They've yet to date been the only entity that has launched a short-range ballistic missile toward Israel. So the reality is deterrence may involve strikes, American strikes on Houthi targets in Yemen, but nobody wants that.
Aaron David Miller, Carnegie Endowment for International Peace Senior Fellow, talking with us yesterday on Bloomberg Surveillance. Of course, Middle East tensions, where we go from here, that is certainly front and center. We're going to get into that in just a moment. Quick check on the markets for you on this Friday morning. S&P 500 futures just up about 2.25 points, 48.34. Will we hit a record on the S&P? We're watching that level, but 47.96. We didn't get there yesterday. We'll see if Friday is the day. Taking a look at the 10-year, 388. So just up a little bit as we get ready to wind up this year. And then New York crude, watching that very closely all week. We did see a little bit of a spike earlier in the week as concerns over escalation in the Middle East. 72.12 a barrel, just up about 35 cents. Oil. We continue to keep a watch on it, guys.
Yeah, I mean, this oil market, we're going to have Amrita Sen a little bit later on. I think it's going to be interesting to see where Amrita talks about the gravitational pull. OPEC Plus have got their work cut out for them. They've committed to these cuts. Still, this market is limping along. And then you look at the supply. We talked about a Cushing yesterday. The inventory is rising to a 9-month high at Cushing. But then the national numbers show a draw for the first time. But it hasn't been that cold in this country yet. You'll probably both tell me that I'm in for that experience.
It's not. It hasn't been. Oil headed for the biggest annual drop since 2020, Katie.
Yeah, really interesting, again, when you think about the past 2 years, also what that's meant for energy equities as well. But to Manus's point about supply, that has really been the dominant story in this market, even with all of the geopolitical tensions just layered and layered on top of that.
Yeah, energy equities, you look at the major industry groups, the S&P down 4.6%, one of the laggards, no doubt, this year.
Just one thing to keep in our minds is that Jeff Curry, this time last year at Goldman Sachs, was evangelizing a super cycle in oil and commodities, something that we can bring up with the guests through the morning. But oil at the moment shows no sense of war premium.
All right, so let's talk about the potential for an escalation of war overseas. Norman Rule is former senior U.S. intelligence official and senior advisor for the Transnational Threats Project at CSIS, joining us here on this Friday. I can't even keep track of the days. They kind of are blurring. Forgive me, Norman. Norman, though, nothing blurry when you continue to watch what's going on overseas and what feels like an escalation. What struck me and some of our guests yesterday was not just a handful of attacks, but more than 100 attacks in the region that are happening at this point. So little things that are happening, and you wonder, does it add up to something much bigger? How do you strategize that?
Good morning. Iran and its major proxies outside of Hamas have no strategic drivers to directly involve themselves in a conflict in a way that would risk a significant escalation that would undermine their own equities and stabilities. At the same time, they have multiple incentives to continue the current pace of attacks throughout the area of operation in order to keep Israel under siege, to show defiance and weakness of the West, particularly the United States. So we should expect these attacks to continue, perhaps with the quantity and occasionally the intensity increasing as these actors believe they have normalized their behavior or they have passed what were previously perceived to be red lines.
Good to have you with us this morning, Norman. Look, the Pentagon is daily engaged with shippers in the Red Sea. They have said they're engaged with an industry on a near daily basis to provide reassurance to the international community that there is help with safe passage. But is this perhaps the near-term flashpoint of where we really need to be focused? Because there seems to be a reluctance to really cover the maritime needs. What do you make of the Pentagon's reassurance in the Red Sea?
The number and quality and capacity of the naval assets the United States and Europe has put into the Red Sea, the Arabian Sea, is extraordinary. There are hundreds of offensive missiles and air defense missiles. We have more than enough capacity if we wish to launch a significant and powerful strike against the Houthis.
But is that what Iran via its proxies wants to prompt? It really wants to prompt that reaction, isn't it? That is the flashpoint risk for us.
It is, but at the same time, it would not be unreasonable to think that Iran understands that the West is not interested in such a conflict and that they can continue a certain level of activity without reaching a red line that provokes this action. I think what you want to look for is there a strike that unfortunately would hit a bridge of a ship or kill a crew or hurt a U.S. air seaman? This would provoke a strike by the United States or partners against the Houthis. But unless that happens, the history of the recent weeks has shown we're just going to play defense, and that is something that allows the Houthis to continue their behavior.
Let's pivot to the Hamas-Israel conflict. It's extending into this Christmas, into the new year. You would say the intensity, I want to understand where we are. You would say that militarily, the IDF, in your opinion, has succeeded or finished its focus in the north of Israel. But how far are we from any cessation? Because this battle runs hard and long in the south. Your assessment of the IDF's desire to ramp off?
Well, the IDF certainly would like this conflict to end as soon as possible, but that's a long time from happening. They're in holding operations and some counterinsurgency work in the north, but Khan Yunis and Rafah in the central and south part of Gaza are very difficult urban environments. It's a very challenging series of operations. The tunnel structures are massive. The leadership still remains of Hamas, still remains on the run, and this is a difficult ground operation for Israel's military, as it would be for any military.
Well, Norman, let's talk about what's going on in North Gaza at the moment. You mentioned that shift from attack to really a holding pattern at this point after, of course, the IDF achieving, in your view, most of its military goals. What does holding look like? What does that mean for civilian casualties and suffering, for example?
Well, suffering is going to be a constant, unfortunately, for the Palestinian population. It's a stain on our generation. But for North Gaza, the Hamas's capacity has been significantly eroded. There are certainly elements of Hamas who are still active, but they have very little command and control, very little intelligence. This is an insurgency in a sea of rubble, in a sea of deserted homes. This is designed for guerrilla warfare. But at the same time, the numbers are comparatively small. And this allows the Israeli Defense Forces to shift the bulk of their power to the center of Gaza and to concentrate on Lebanon or Syria.
Norman, we talk so much, understandably, about what's going on between Israel and Hamas at this point. When I think about the economic impact, we've talked about the shipping impact, certainly, and there's more nervousness when it comes to the Red Sea. You, in your notes that you share with us, you talk about the Houthis continuing to exert an outsized ability to exert pressure on the global economy and to impose hundreds of millions of dollars in costs upon the U.S. and dozens of countries. It sounds like our focus needs to be on the Houthis at this point because they seem to not be willing to necessarily stand down. They understand the pressure that they can impose.
That is correct. And again, Iran has always intended to develop a capacity through proxies to have an influence against the West in general. So with the Strait of Hormuz and with the Bab el-Mandab, the base of the Red Sea under their control, they have a capacity to touch global supply chains, global energy, impose these costs on Western economies in a sense as a way of sort of asymmetric sanctions on their adversaries.
Norman, I have to say, just got about 30 seconds here. I always think about when I'm at the end of the year, what am I going to be talking? What are we here at Bloomberg going to be talking about a year from now? Do you believe that this conflict, an expanded conflict, will be top of mind 12 months from now?
And the impact, certainly. I think we need to look at what's happening in Lebanon. More than 60,000 Israelis have been moved from the North Lebanese border. They must return home. More than 75,000 Lebanese have been moved from their side of the border. At some point, the Israeli government and the international community are going to have to grapple. How do you convince Lebanese Hezbollah to stop firing, to allow these people to return to their homes? If that doesn't happen, this conflict could spread.
Important insight. Norman, thank you so much. Happy New Year. And let's hope it is a Happy New Year. Norman Rule of CSIS joining us here. This, as I look at WTI crude, just up about 0.5%, $72.06 a barrel.
Indeed. I think what Norm had to say there, which was about the quality, we've questioned this prosperity guardian in the Red Sea. And as he made very, very clear, actually he's qualified it. He said, look, the quality of what they've got there is very high, but they're going to play defense rather than offense. But then, of course, that's what the Houthis want to push them to, an offensive move.
And it gets more and more complicated as we watch kind of all of these different groups that are around the globe that are doing different types of attacks in different regions. Cumulatively, you wonder what will it ultimately mean going forward, and how does the U.S. and the rest of the world react? Coming up at 6:45 a.m., I'm Rita Sen of Energy Aspects. This is Bloomberg. And for our audience worldwide, very good morning. This is Bloomberg Surveillance Live on Bloomberg Radio and Television. Alongside Manus Cranny and Katie Greifeld, I'm Carol Massar. To the markets we go, pretty quiet, no surprise, on our last trading day of 2023. S&P 500 futures call it flat, just up 2.5 points there. You're looking at NASDAQ futures up about 0.1%. Oh, a little bit of momentum. Whoop, whoop, whoop,
I'm
whoop.
speechless.
All right.
Speechless looking at these futures.
Welcome to the world of sarcasm. All right, Russell 2000 just call it flat as well, but that's really been an outperformer, and we've seen some momentum in this late year movement, if you will. Let's flip it on over, take a look at what we're seeing along the curve here in the United States, the Treasury curve, 2-year 4.29. We're looking at a 10-year. A little bit of movement to the upside, right?
Quiet rise in yields.
Quiet rise
today and yesterday. We'll see if that has any steam.
It's all quiet at this end of the year. 388 on that 10-year note, and looking at the longer end, the 30-year 403. Let's move it on up. Take a look at what's going on in the currency trade in a year where we are seeing the dollar set for the worst year since 2020. You've got the Swiss franc rising to its strongest level against the dollar since 2015. What does it mean, though, when we look at the euro-dollar cross? We've talked about parity, some projections of that in the new year. Right now we're looking at about $1.10 to the euro. All right, that is your market setup on this Friday. Let's get to some of the other headlines we're keeping a watch under surveillance for you on this Friday. A second state ruling Donald Trump cannot run in its Republican primary, with Maine the latest to bar the former president. Colorado also banned Trump earlier this month, both states citing Trump's efforts to overturn the 2020 election results as reasoning. Trump is, however, back on the ballot in Colorado while he appeals that decision and could appeal the ruling in Maine as well. One thing we know, there's some uncertainty as how this eventually ends, but there's going to be a lot of court rulings on this.
I think this is going to bubble and come time and time again throughout the start of 2024 until we see how the Supreme Court actually rules on some of these things. The Trump campaign made this statement: we're witnessing in real time the attempt, again, there's language from the Trump campaign, very reminiscent of the challenge from the Trump campaign around the election. We're witnessing in real time the attempted theft of an election and the disenfranchisement of the American voter. And that was the campaign spokesman, Stephen Chung.
Yeah. So a lot of court drama coming up, a lot of lawyering, also a lot of campaigning on this from both sides. Obviously, Trump trying to capitalize on this. The Biden administration as well. The Biden campaign really saying that having Trump return to office would threaten the country's democratic institutions. So really,
well, that sounds a little political.
I know, really matching the Trump campaign's level of drama there.
I will say that there's a great story in the Bloomberg. Michael Waldman, he's the president of the Brennan Center for Justice at NYU School of Law. He says he expects the Supreme Court to decide not whether Trump engaged in insurrection, but who has the authority to decide whether such an act bars him from holding office in the future. But it gets really contentious because many would argue you keep him off the ballot, it's just going to kind of get his base even more excited. Like, is that problematic in keeping him off? I don't know.
Well, there's even been some pushback from some of the Democratic judges in terms of how the law is being interpreted and what is happening. So this is not a slam dunk kind of politicized situation. The Supreme Court is going to have its hands mighty full at 2024, a new docket for them.
Yeah, rule of law, though. We've got to remember that is really important. All right, you talk about slam dunks. Here's a slam dunk for you. Chinese stocks set to record their lowest ever foreign inflows in 2023 as the country's economic struggles weigh on investors. Foreign funds bought just over $6 billion worth of onshore stocks this year. In better economic times, investors would buy that amount in a month. So talk about a difference. You keep reminding us, Katie, you look at emerging markets, back out China, they've done well. Include China, not so much.
Ex-China, that seems to be the phrase of the year. But it's a pretty amazing amount to put those numbers to it, that just $6 billion in a year for Chinese stocks.
Carol likes the dollars, not the yuan. Now, just remember that. 53 billion yuan, $7.5 billion.
I'm thinking about my U.S. friends who are watching right now.
But we talk about investor confidence, this uncertainty over Beijing's policy, what they're going to do. I mean, we just saw that in the past couple of weeks with that gaming situation, the rules there, and then the U-turn ultimately. So there you go.
And everybody was so full bull on this. I mean,
absolutely.
You know, I mean, it's not that the only analyst that we're going to quote is Goldman's, but they were so bullish, weren't they? They were calling China stocks up 15% at the start of the year. They said the yuan would drop to 6.5 by the end of the year. It's not. They were not in splendid isolation alone, not at all. The whole world had not bet the house, but we were all sort of like that, going, I hope China really,
Yeah, investment management. I believe they called this the decade of EM, and maybe, again, EMX China. But, oops. Yeah, but China's a pretty big portion of it, so.
All right, speaking of big, Francoise Bettencourt-Meyers, the granddaughter of the founder of French cosmetics company L'Oreal, is the world's first woman to amass a $100 billion fortune. This is according to the Bloomberg Billionaires Index. Meyers' worth and wealth, I should say, passed the century mark this week on the back of a strong year for the company. Shares of L'Oreal rising more than 35% this year, its best since 1998, and we're going to have more on the Bloomberg Billionaires Index in the next year. Yay, go women. I'm always, though, every time we do a list or a poll, it's like, finally, one woman gets there.
Yeah, and,
it's a heck of an empire. But here's the thing. Even if you go into recession next year, okay, that's a risk. The lipstick index was founded by actually Estee Lauder's Leonard Lauder.
Yeah.
In a recession, in theory,
sons.
you two tell me. In hard, not that you two have ever had a hard time, but in hard times, apparently the lipstick index is you buy yourselves smaller things to keep yourself, you know,
small
life's
luxuries.
okay.
I mean,
small luxuries.
That was a theme for the consumer this year. You really saw, and maybe it wasn't lipstick, maybe it was buying Starbucks cold brew every single morning.
Have you paid for a Starbucks cold brew recently?
Katie sounds like she's talking her book.
I don't know. Couldn't be me. I don't know if I'm speaking from personal experience.
Every time we do a coffee order, it's like, can I have a
cold brew? Are we going to Starbucks?
Are we going to Starbucks? A lot of people went to Starbucks this year. Okay, lipstick index and Starbucks. We talk about more of those with our investment managers as the morning progresses. Let's talk about Bill Gates, because, of course, he was at COP28. He said this: the world probably won't meet its Paris Agreement's goal of keeping the temperature rise below 2 degrees. Bloomberg's Francine Lacroix spoke to Gates at the COP28 summit in Dubai earlier this year and began by asking him the role of fossil fuels going forward.
Well, we have to outcompete fossil fuels. Now, to do that properly, they shouldn't get subsidies, and in fact, a carbon tax over time should be put on so that the new, say the electric car or the plane that use hydrogen, the fact it doesn't emit carbon, you're helping it get adoption. Those companies have skills, if you want to sequester carbon or, nuclear waste, or there's a lot of skills if you want to make biofuels. Some of those companies will take the capital and skills they have. So I wouldn't, say, okay, I wish they weren't there. People still, there's no country that can say, okay, we have zero emissions. People want to drive to work. In fact, the excess supply, when Russia cut off its supply, the world was sort of glad that was available. And so, yes, oil and gas needs to be outcompeted, and those companies need to join the effort.
I know you look at a lot of technologies and a lot of innovation, but is there one thing that you've been most excited about in the past 5 years, or that you're most excited about for the future? I know we talk about nuclear fuel. We talk a lot about the really big, exciting stuff. What are you excited about?
Well, I love all my children, and I have these 100 companies, and I never knew that we'd get a new way to make steel or cement or beef. It's fair to say that if we can get either nuclear fission or fusion to be safe and broadly accepted and very economic, because it's not weather dependent, it would be very complementary to the large amount of solar and wind that we're putting into our electric system. And so I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time. We can't count on it. fission has been too expensive, and fusion doesn't exist yet.
But fusion, 15 years from now, like what's your? I know it's a guess at the moment. But
well, of the 4 companies I'm invested in, one of them, Commonwealth Fusion, has a credible path. Things will have to go well. That in the late 2030s they'd be making electricity and start to scale it up. So that's an aspiration, but it's a great company, and we have 3 others that aren't quite that early, but are within 5 to 10 years of that.
I mean, we're in a strange place in the planet right now because there's a lot of unknowns. It's AI, it's technology, it's of course climate change. Do you find leaders distracted, or are they still putting climate change as some of their top priorities?
Well, we can't have as our only priority. I mean, we still need to buy vaccines and bed nets, and when there's a war, that properly demands attention, and even the aid budget, for those refugees and everything. It is, I wish there hadn't been a pandemic or Ukraine war or Middle East unrest. Those are going to take away from the amount of tension we have on continuing to make health progress and climate change. So, those are bad developments. If you'd only seen 10,000 people come, versus 35,000 last time, you might have said, wow, we are really getting distracted. Instead, twice as many came here, including a lot of the big businesses. So the signs I'm seeing are that while we still have to deal with those things, and we have limited resources, so we have to spend them well, that climate progress is moving ahead, even though we won't meet our highest aspiration.
Bill Gates, one final question on AI. How does that fit into your vision for?
Well, AI is such a powerful technology, and this recent advance where the AI can basically read and write, that's going to affect every human activity. And so we're using AI to find new drugs. We're using AI to look at climate change. And so all of our companies are going to move faster because AI helps them explore different solutions and move a lot better. So, certainly for challenges like this, AI is very much our friend.
AI is very much your friend. Bill Gates there speaking with our very own Francine Lacroix at COP28 in Dubai earlier this month. And it was a historic COP for a whole host of reasons, not least because it was the first time that there was an agreement to move away from fossil fuels. Gas is going to be the transition. The consensus seems to be gas is going to be the transition.
They had to fight to get that. That was not a difficult thing.
It was right down to the last one.
Yes.
I mean, to know Sultan Al Jaber, and I've interviewed him several times, he's a colossus of a man. And what he did was at the end, he moved away from the very formal processes and he took them into what's called a majlis. He took them into his own sort of, UAE house and coalesce them around. An agreement, he said at the end, is only as good as its implementation. And that's where we are now. It's about implementing what they've agreed.
Well, thinking about where it was held, that the event was held, smack there in the Middle East, right? You know what is so important to their economy. Having said that, what I thought was interesting that Bill Gates had to say, talking a lot about fusion and fission and nuclear power. And I feel like in some of the energy conversations I've had this year, that has been a big focal point. We've seen it really reduce from the mid-1990s to around today. About 10% of world electricity is produced by nuclear power, but climate change is making everybody take another look at this, Katie.
But even still, I mean, I feel like the timeline issue is still very much real. We were talking about this a bit yesterday, and you think about, some of these deals that have been agreed to and some of the promise of those technologies that you talked about. But again, the here and now, trying to heat a country, et cetera, how do you keep the urgency up on such a long time frame, I think is a question for a lot of these leaders.
You were right to sort of say the irony of where it was held. It was like letting the fox into the chicken coop. That was what the accusation was. Absolutely. And just think of the UAE. They've agreed to sort of restrain themselves in their oil production. They've got the capacity to get to 4 million. They're way under that. And if they've got international investors, as they do quite easily, they can get to 5 million. So you're not looking at oil and gas going away.
Yeah.
It's just a question of the timeline, to transitioning away from fossil fuels and the reality of that pointed out by the Saudis.
The U.S. approving a new kind of nuclear reactor for the first time time in 50 years. It has to do with cooling, but you're seeing so much momentum around this space. We're going to continue talking energy, fossil fuels coming up. Amrita Sen of Energy Aspects on the oil market. Curious to see what she has to say and about the mix and the timing of backing off of fossil fuels, because it feels like we are still all in. This is Bloomberg.
I don't like to predict oil prices, but I wouldn't be surprised if it's more than several dollars a barrel. I do think that this risk is being underestimated now, and I think that the fact that U.S. supply and the fact that we know OPEC is holding so much oil off the market is kind of negating that geopolitical risk at the moment.
Above 80?
She's pushing.
I'm not going to say no.
There you go. The final provocation.
We tried.
The provocation from Carol Massar. She got it there. Price out of Alan Wald, slightly above $80. Alan joined us yesterday. Alan Wald from the Atlantic Council, where she is a senior fellow. And oil trades this morning in WTI 72.02. Carol, there we are at the bottom of the board, up a third of 1%. That's not exactly what you would call a war premium, is it?
No, not at all, which is kind of interesting. But we also talked yesterday about stockpiles, and we think about that, Katie, right? When you're looking at the energy markets and what's going on in terms of the amount of oil that's out there.
Yeah, and we talk about supply. We've talked about that all week. Where's the demand? Obviously, that's one of the big consensus calls that went wrong. You think about Chinese demand in particular.
I'm filling up my tank. I don't know about you guys.
Yeah.
Well, we got it, and the supply. The U.S. pumping like Billy-O, pumping over 13 million barrels and exporting with gusto. Amrita Sen is our guest on the oil markets, closing the agenda. You probably started the agenda, and you will close the agenda for Bloomberg on oil. Director of Research at Energy Aspects. The debate is this. The war premium is being subsumed by inventory build. Will that continue? And are we mispricing oil? Is there a sufficient lack of war premium, in your view, in this market? Amrita, good afternoon, good morning.
Good afternoon, good morning, wherever you are. I know it's like different parts of the world. I know you guys are in New York, so good morning. I think, look, in terms of war premiums, agreed. There is no geopolitical risk premium in the price right now. And that's as much to do with the concept or the notion that demand is weak. If anything, demand has been growing at over 2 million barrels per day this year. I mean, 2.2 million barrels per day. Next year, it should be slowing. We are expecting it to slow, given kind of higher interest rates and the lagged effect of that on the economy. But it's still going to grow. It'll be growing by about 1.2 million barrels per day. I think the bigger challenge has been a lot of traders and speculators have been badly hit this year because trading hasn't been easy. It's been very choppy, and we just don't have the confidence in these guys to come back in strong. So we need sustained stock draws. We had big stock draws in the DOE numbers yesterday. If we see a continuation of that, I do think confidence is going to come back, and that's when you're going to start to see geopolitical risk premium come back to the market.
Yeah, national stockpiles dropped by 7.1 million barrels, but you still got an inventory build at Cushing. So there's a trigger event, isn't there, at the beginning of the year? We have these additional voluntary cuts of 900,000 barrels that we've spent agonizing days debating whether they are robust or not. So take us through the cuts that OPEC Plus will implement. The Saudis continue with a unilateral cut of 1 million barrels. So take me through the deficit as you see it for Q1. When will it materialize, and what size will it be?
So Q1 and even early Q2, I would say the OPEC cuts mainly go towards offsetting what would have otherwise and seasonally are bills, because this is when refineries go down for maintenance, right? So this is always a weak period for crude. Oil products will be very strong, so gasoline and diesel. And I think OPEC is, and particularly Prince Abdulaziz, has been very clear in his views about this, that he wants to make sure inventories simply do not build. We could see a small draw, counter-seasonal draw. And I think really from the latter half of the second quarter, once refineries are back from maintenance, you're going to see crude drop very sharply. In the meantime, the product markets will continue to tighten. So overall, hydrocarbons will actually look tighter. It's just the products markets will be a lot stronger, and crude is seasonally in its weakest period anyways. OPEC, if they manage to keep inventories in check, that would be a pretty impressive feat, because usually, we build first half and we draw the second half.
Amrita, I want to go a little bit more macro. You've talked about Europe moving away from Russian oil. We get that because of the war over in Russia and Ukraine. Specifically, you guys work with, consult, or people rely on your research, oil companies, traders, hedge funds, utilities, governments. What about the moving away from fossil fuels, the energy transition? What is the constructive conversation around that you are telling them?
Great question. I think I would hope, at least through our conversations, there's a little bit more pragmatism that is seeping through, and particularly after the war. Because look, at the end of the day, energy transition can only exist as long as we all accept that it's not going to happen across the world at the same time, because we still have, billions of population, be it in Africa, Asia, and in Latin America, below the poverty line, and energy is at the epicenter of any economic growth. And energy transition, I keep saying, it's a very nice Western concept where we can tell people that, oh, by the way, you don't get to grow. It doesn't work like that. So I think that's the first thing, that it's not going to happen at the same time, at the same pace. But the second thing is also the true cost of it, right? We can't just move away from fossil fuels overnight, because if you think about renewables, they are not reliable enough all the time for electricity. So suddenly then you need gas. And there's an enormous amount of investment that's required. And one of the challenges I find in energy transition is, everybody talks about being for energy transition, but nobody wants to pay for it. Those are the two key themes, I would say, when we talk about energy transition that we focus on. And it's really about kind of, honing in on decarbonizing hydrocarbons. To say we're not going to require fossil fuels, it's to the detriment of the industry, because we have seen, if anything, oil demand, gas demand continues to grow, and we haven't been investing enough. So I think that's where we should be very careful about talking about transition away. It needs to be a transition with or including fossil fuels, but a low carbon fossil fuel world.
If we have the time, when I look at climate change.
Well, I want to stick with the transition conversation and bring this out to a longer time frame, because we were talking about COP28 just a few minutes ago, and the fact that for the first time, of course, you saw that fossil fuels have made it into a global climate deal, basically, of course, agreeing these countries to curb their consumption, their production of fossil fuels. You talk about, of course, that this is going to be a drawn-out process. Over what time frame does that transition become bearish for oil?
On our numbers, we don't have oil demand peaking well into the 2030s. And that, too, I would say, gasoline peaks at the end of towards the end of this decade. Diesel peaks in the early 2030s, but jet fuel, petrochemicals continues to grow. But, one of the reasons why I don't like using the word peak oil demand is a peak kind of implies it's like a mountain, right? It goes up and goes down. Even by 2050, on our numbers, oil demand is barely below 100 million barrels per day. So it's more like it kind of, let's say, peaks in early 2030s, but then it's a plateau. It kind of gradually plateaus out to slightly declines. I always go back to April 2020, when it was the peak of COVID. We were all at homes, not flying, not driving. We still consumed 80 million barrels per day. I think that's a staggering number. And we should remember that that's how inelastic oil is, that even when none of us traveled, I don't know what we were doing, ordering toasters at home probably, but Amazon definitely did very, very well.
A lot of cooking and a lot of heat. Look, we're in the closing minutes. Let's squeeze you 2 for 1. It's better than Waitrose, Tesco's or Stop and Shop. I want a price of oil in Q1 on the squeeze and the draw. And the second, Angola's gone from OPEC. Do the Emiratis raise their swords and have a bit of a swagger in the first quarter? Is there going to be more angst at OPEC? 2 for 1. Quickly.
I'd say second question first. I know not at all. I think unity is fine. Angola, we know, long story, doesn't affect anything. They can't even raise production. But unity is fine. Second question, in terms of prices, I think, again, confidence needs to come back. So we probably hover around the $80 for Brent in the first quarter. I'm not seeing a lot of upside. But second half or second quarter onwards, I do think prices will be in the 80s and probably 85 above.
That's a big bump from here. Yeah.
Yeah, that's going to be quite a squeeze together.
Yeah, a little bit.
It's good to see that you got the message from Sahil Al-Mazrui that there's no angst. We've got the capacity to produce 4, but we're absolutely fine. with sticking around the threes. Amrita, I'll see you somewhere in an alleyway in Vienna doing a report on oil, I hope this year. Amrita Sen, Energy Aspects. She's probably one of the most sporting analysts that there is out there. She gets up early in Vienna, 5 o'clock in the morning. She's on the curbside. She loves it. She does toe-tapping dances as well. $80 and above. That's quite a punchy call.
Yeah. We have a viewer writing in and saying climate change was going to be exponential. So, like, I listened to the use of fossil fuel and that it's going to continue as temperatures continue to rise and rise. We saw it here in New York over the summer in terms of fires coming out of Canada caused by climate change. I don't know. Can we afford to continue to drill?
Well, I really liked her phrasing, her language about how to talk about that. Peak oil demand, it's not a peak and then, a mountain, how a mountain is shaped. It's a plateau. That I thought the tie back to the pandemic was very telling.
What were we all doing in the pandemic? Cooking?
And buying from Amazon, who had to get trucks out there to get it to us.
That's true. I feel
so
like we
much
were
stuff
all
being
baking
ordered.
bread. Everyone had their sourdough.
I was at the beach.
Really?
Yeah, I was in Dubai.
I was in New Jersey.
I was working, walking the dog.
I did work.
I know you did. Hey, coming
all
up,
worked.
Our next guest says to break well above 5,000 on the S&P, we're going to need to see better performance out of the other 493 names. Brooke May of Evans May Wealth. We're going to see her argument, hear about it. This is Bloomberg.
We are really, I would say, in much more uncharted territory than markets believe today.
We have seen some incredibly volatile movements in the market. It's likely that we're going to continue to see that as we enter into 2024.
What I do see in 2024 is a more broadening out of performance.
We would say any volatility really provides an opportunity for investors to get involved.
We might actually have a more boring market than you think in 2024.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City, for our audience worldwide, a very good morning. This is Bloomberg Surveillance live on Bloomberg TV and Radio. Alongside me, Massar, Katie Greifeld, a very warm welcome. I'm Manus Cranny. Superlatives will fly. The print team, you will work with the print team on the superlatives for the rest of the day. And if she gets a red-hot headline on the record high for the S&P 5, fingers crossed. But I think it's probably the dollar. We talked a lot about volatility in bonds, in equities. I mean, last year, at the start of this year, I should say, we started with a bang, didn't we? Pumped up 6% in equities. China was going to reopen. Luxury was going to be the holy grail. We're all going to continue with revenge shopping. And equities continue to outperform. It was the year of a silent recession rather than an aggressive slowdown that annihilated the equity market. It didn't happen.
It didn't happen. I like silent recession. I like rolling recession. All of these words to describe basically that big recession that everyone was predicting, it didn't happen.
For a second year in a row.
For a second year in a row. You bring up the dollar, and I just think it's funny. I was playing with the charts. You take a look at the Bloomberg Dollar Index over this year. If you haven't been paying attention since October, you would be very confused because you think about how dominant the dollar was, how strong it was, and really this big swoon that we've seen really feels like the whole game changed since the end of October.
I just keep thinking about how, a year ago, what we were feeling, what we were expecting for 2023, and how so much of that didn't play out. So what are we potentially here on this last few days of December thinking about and that we're going to ultimately get wrong? Sorry, everybody, but it's just a reminder, kind of keeps us humble. That recession that we keep calling for. We thought China would come back. Is this the year that we finally see China start to come back? And do we see investors kind of move into that area? Although we've had kind of mixed views on it, I feel like this week.
I'm thinking about breakfast, I gotta say.
I know you are.
Just for everybody who's checked in, these two have already ordered the breakfast, and they've gone long and large.
Yesterday, we ordered it.
Long eggs.
Yes, long eggs and long what?
Long eggs, bacon, some juice, and a cappuccino.
We're living the dream. We're quite literally living the dream on Bloomberg Surveillance on the last trading day of 2023. Let's give you a snapshot of markets. If you weren't in NVIDIA, if you weren't in Tesla, you were not in the winning trades. NVIDIA up 238% on the year. There's the S&P 500, 48.34. 0.75. Euro dollar came in at number 4 in terms of its performance against the Yankee this year and having its worst year, as we said, since 2020, down 3% on the dollar index. Yields, we did not break through to the low of this year, Katie, did we? What were we double checking? 374 was approximately the low, and that was about 6 months ago on yield. But you say there is a gravitational force in these bond markets.
At least when it comes to the 10-year, it feels like the 4% level is really where it wants to be. And you've seen that in the last couple of days, even amid very thin volume, this quiet rise that we've seen in yields this week.
The quiet rise.
Quiet.
Right?
Love it. Waiting for something.
Absolutely, and then of course the dealers, they
Maybe
got
the Fed?
well, the dealers got stuffed in the last auction, didn't they? They got left holding the baby quite literally yesterday in the 7-year auction. So maybe that just backed up the yields a little bit.
We have another auction, don't we, today?
No, that was it. We're done.
Another 5 year? Oh no, we're done. We're done.
I'm sorry.
Sorry.
Got to wait until next year.
Told you I didn't know what day it was.
Yeah, just keep thinking the bacon, the eggs, and the orange juice when it comes. Let's take it all to our next guest, see what she makes of it all. It is Brooke May, managing partner at Evans May Wealth. So you're already casting forward to 2024, and you set the table very clearly. You talk about earnings, we'll come back to that in a moment, but to break the 5,000, the magic 5,000 level on the SPOO, we're going to need to see a better performance. Here's a shocking statement of 2023 of the other 493 names, excluding the Mag 7. So this is a question of breadth. But when our last guest said, run your winners, and if you want to go for breadth, you maybe leave NVIDIA or have some NVIDIA, but you go to Broadcom. NVIDIA up 280%, Broadcom up 100%. How do you define breadth?
Morning. Yeah, I would define breadth as really the other 493 names, but in addition to that, dipping down into small cap and really even fixed income that's rallied. So we're just seeing broader participation across the board. Names that didn't necessarily soar early in the year, like the big tech names. We're seeing some cyclicals right now rally, in addition to some names that have been beaten up starting to recover and take a leg up.
I do wonder, too, though, Brooke, a lower rate environment is often so great for those hot tech names, if you will. So having said that, if we indeed get that lower rate environment, some say very aggressive in terms of the Federal Reserve. Of course, we've got to counter that with, does the economy here in the U.S. Start to fall apart? But could we then see those Magnificent Seven continue to rally?
I think so. We have not cut our allocation. As we've seen some profits, we've taken those, but we still like the big tech names. They've got profitable growth. This isn't the tech bubble. These companies are growing, they've got earnings, and we expect them to continue to do well. But in addition to that, see broader participation amongst the other assets in large cap, small cap, fixed income, et cetera.
And Brooke, I'm reading through your notes, and the section on money markets jumped out to me. I'm pretty obsessed with the fact that you have $6 trillion sitting in money market funds, $1 trillion of that coming just since March. You write that there will be a rotation out into equities, but you also write that if investors didn't transition from money markets to bonds when rates are 5%, it is unlikely they will make the move now with rates lower. It sounds like what you're saying is basically the cash that's in there is pretty sticky.
5%, 5.25%, it's pretty comfortable to sit there and have peace of mind that you're going to have that price stability and earn a little bit. But those yields are going to come down. As rates come down, we're going to see money market returns come down, and they're not as attractive. If investors didn't go out and lock in corporate bonds at 5.5%, or municipals at 3.5%, it's going to be hard to do, hard to stomach at least, whenever rates have declined. Not just 1%, but 1.5% or 2%. So as people are dissatisfied with the lower returns they're getting in their money market, they're going to look for better opportunities. And I think that money will find its way into the equity market.
It's interesting. We had a couple of guests here this week that said you couldn't give bonds away at 5 and 5.25% because we were racked with fear. We were racked with fear. We'll extend that thought maybe into some of the bonds in that sit side by side with the equity names in a moment. But I want to pick up. You have a call on Charles Schwab, and this goes back to one of our guests earlier that also had a bullish call on Charles Schwab. And you say obviously other stocks making 52-week high. This one is down 16% year to date. Why such an opportunity in that? Because it did get, as Katie said, swept away and thrown out with the bathwater during the First Republic debacle. What is the core health of Charles Schwab relative to the other names in that sector?
Schwab has its earnings really come from two sources. One are revenues and fees that they generate on the advisory retail side, and the other is from net interest. And it's hard to make money in net interest when you've got an inverted yield curve. So as we return to a traditional sloping yield curve, there's going to be an earnings pickup there for Charles Schwab. In addition to that, they've just completed the merger with TD Ameritrade. Through that, there's going to be additional revenue growth, cost synergies, and really some opportunities to capitalize on that broader client base. So there's a lot boding well for Schwab, and it's cheap at this point. And we feel like over the next few years, there's going to be great return there.
Household net worth is at an all-time high of 172 trillion. Of course, a lot of that is locked in house prices. House prices at a record. The Case-Shiller data yesterday really pushing that through. When you look at house builders, when you look at that ecosystem for next year, if we go into a rate-cutting mode, do you see higher house prices and more momentum in the house building peripherals around that?
I do. There's pent-up demand. When you look at household demographics, we're creating more and more households that need homes and apartments, and we've been underbuilding for the last 15 years. It's been a challenge. So a lot of people are waiting on the sidelines, hoping that rates will come down, and we're still in a situation where we've got very little inventory. So if rates come down and it kind of loosens things within the market, people are going to jump back in. We're going to see demand, and demand is probably going to continue to lead supply. Therefore, prices are going to move higher as we see rates decline.
And Brooke, I mean, I have to wonder how much pent-up demand is there on the other side of mortgage rates being as high as they are? Once they drop, I have to imagine, I mean, maybe speaking from personal experience, there's a lot of people that would like to buy. How are you thinking about some of those factors in the housing markets in that call?
Yeah, they haven't been able, you can only stay in your parents' basement for so long. At some point, you get married, you have children, you need more space, you have to move. There are lots of reasons why people will buy a home. And studies are out there that say at one point this past year, we had 6 million too few homes in the country. That's a combination of single family and multifamily, but there's demand there. And when that demand exceeds supply, you're going to get price appreciation, and lower mortgage rates are only going to help.
Hey, one more name I want to squeeze in before we wrap up here with you. Netflix. You like this one. It's up, 66% year to date, sitting near a 52-week high here. What is the story? Because I feel like so many people go home and they're like, nothing to watch. And yet, there is a lot to watch. But what is it that you like about Netflix specifically?
We like dominant players in their space, and Netflix fits the bill there. When we look at their Q3 earnings report, it was amazing. They beat earnings by quite a bit. And really, their subscriber growth is what's got us excited. The street was expecting them to add about 6 million net new subscribers in the third quarter, and they added 8.8 million, which is significant. And that was really driven by a few things. One, they've cut down on password sharing. They've also scaled their ad-supported tier. And then their content. Their content is superior in our belief to some of the other competitors out there. So they went from a company that had 4% profit margin in 2016 to, we think they'll have 22, 23% margins next year. So they're growing profitably, not just at any cost. And we think that they'll continue to do well going forward.
It's all about Bridgerton. I'm just going to put it out there.
Absolutely. Well, you've just finished. You've just finished The Crown. I've just finished.
I did.
I just finished. No, I've just finished The Crown. You've just finished Beckham.
I did.
There you go.
Brooke,
a lot of stuff.
Brooke, thank you so much. Brooke May, Evans, May Wealth, with some pretty punchy calls. Netflix, Charles Schwab, both in your portfolio for 2024. The opportunities are there. If you're just joining the show, this is what we got for you on markets. The S&P 500 is attempting to have its last hurrah. It's up just a half of 1 point. That's 0.1%, 4832.75. Will the hurrah continue into 2024? That was a pretty bullish set of calls.
Yeah, I think so. Yeah. And especially when it came to even the Magnificent Seven, I feel like she said, yep, we need to see the market broadening out. We should expect it in the new year. But she doesn't say that means you're not going to see big tech still getting investor attention and a lot of love.
And who knows if 1 week of conversations makes a trend, but it feels like we've spoken to people with varying degrees of bullishness. I don't think we've spoken to an outright bear. I don't know who at this point
like
is
being
saying
all in.
Yeah, or full bear, the opposite of full bull, saying that, okay, the S&P 500, its best days are behind it. We're going to see another annual decline.
I think the most that we've had is maybe a drawdown at the start of the week. You know, we have this weaponized FOMO. I mean, that was the phrase that we started the week with. We then moved to JOMO. What does that mean for the consumer. You've got record wealth there, but there's nobody calling anything more aggressive than maybe a 5% drawdown.
Yeah. No, I think there's a tempering, I'm feeling, throughout the week in terms of expectations of maybe how aggressive the Fed is going to ultimately be in the coming year. And that is certainly going to affect how we trade. And I just think it's going to be a pullback. Again, I'll go back to, and I know it's so, Fed says it again, data dependent. I think we're going to run from data point to data point throughout the new year to try to really get a feel of, do we ultimately see some kind of soft landing or a recession or even a minor recession, and that will determine how things play out.
Well, not to keep making fun of the sell side, but you think about where we were this time last year.
You be careful who you make fun of now.
I know.
You're the one that's got to ring them.
I want to talk to all of you, but I will say, you think about the expectation for 2023. For the first time in at least 20 years, the consensus was that you were going to see the S&P 500 decline. If you put together all of the end of 2023 S&P 500 targets, I think at this point, people are just gun shy about saying, I'm bearish. They really
the brave make brave calls. I think Russell Investments said, I've never seen consensus as wrong as it was in 2023.
If you're a client of one of those managers and you say, well, wait a minute, how did you miss this?
Yeah. Well, I'd be asking for a fee reduction. That's pretty much where I would be. A discount. I love a discount. I love a bargain. Coming up in the show, we're going to talk with Terry Haynes from Pangea Policy. What is it that we are misunderstanding about geopolitics?
Understands that the West is not interested in such a conflict and that they can continue a certain level of activity without reaching a red line that provokes this action. I think what you want to look for is there a strike that unfortunately would hit a bridge of a ship or kill a crew or hurt a U.S. air seaman? This would provoke a strike by the United States or partners against the Houthis. But unless that happens, the history of the recent weeks has shown we're just going to play defense, and that is something that allows the Houthis to continue their behavior.
Norman Rule, former senior U.S. intelligence official and senior advisor for the Transitional Threats Project at CSIS. And he was very clear that Prosperity Guardian, which is the coalition of forces helping to reinstate some of the flow of maritime traffic in the Red Sea, is a force to be reckoned with, and a formidable force at that.
Yeah, listen, this is something that's definitely caught our attention. It affects companies, the shippers, their business models, the cost increase. You think about how that's going to trickle down throughout the global economy. You think about what does this mean in terms of growing escalation and where this goes from here. So yeah, we got to pay attention to this.
But you also think about confidence. To your point, Manus, it's a formidable force. But you think about that story that we were talking about yesterday, that half of the Red Sea container fleet is avoiding that route. Obviously, there's a big reluctance to go on the offensive here, actually strike the Houthi bases, and there's a lot of caution on the part of these shippers.
Well, it's a question of whether the Pentagon can really convince the shippers to return to that lane. Let's take these discussions to our next guest. Terry Haynes is the founder of Pangea Policy. Terry, good morning to you. I mean, you lay it out very punchily, so well done to you. This is what you say about Washington. Let's just start with the geopolitical situation there, because they haven't funded Ukraine and they're reluctant to fund Israel. They've got two hot wars. But you say this: Washington's lazy bare minimum approach on everything, whether it's border security, foreign aid, or building fiscal crisis of great concern to markets, won't cut it in 2024, not for markets, not for the U.S. national and international interests. Markets have essentially ignored these faux pas, these grand faux pas. We've ignored them. Is it our folly to ignore these, and which is the biggest tail risk?
Well, I think what you've got, Manus, here is a situation where you haven't seen in 50 years, where you've got a combination of probably the highest geopolitical risk and probably the highest domestic local risk as well. Those things combine. I think what markets ignore is that going into 2024 with that combination, very simply is, they tend to see political issues by and large as spices one way or the other. Things that things that aren't fundamental to the markets, but provide some minor up or down action. When what they should consider is that lower geopolitical risk and lower domestic political risk in the United States are both foundational to the markets. And we haven't really had had a major conflict in the United States that shook markets since the Second World War. But when it did, the markets went down by 20% in the first 6 months after Pearl Harbor. And I'm talking about a conflict that happened almost 80 years ago, and a conflict in which not as today, more than half of the United States citizens are invested in the markets. So the foundational risks here, I think, generally are, and the volatility.
Terry, let's get more specific, though. Play it out. If markets are ignoring geopolitical risk, what might likely happen in 2024 when it comes to the geopolitical risks? And we've kind of laid them out all throughout the week. Obviously, we continue to watch what's going on in the Middle East and concerns about escalation. You still have Russia and Ukraine. We're looking at China and Taiwan. And then, you've got an election coming up. I think there's some concerns, nervousness here. So play it out specifically what you think likely could happen that investors have to be wary of.
I think fundamentally there will be a temptation to think that the three major conflict areas geopolitically that you just pointed out, Ukraine, Israel, Taiwan, are going to be somehow handled when in fact they're going to continue on for months. I mean, there's no easy end to the Ukraine war. The Israelis say that the Hamas war will go on for months, and I don't see anything there to stop it. And there's a lot of volatility around Taiwan, which I think, frankly, is underappreciated by markets who think that Biden and Xi Jinping have some sort of an agreement after their recent summit, when in fact what China is doing is pushing on kind of undeterred and probably has more rather than less incentives to act thanks to their more parlous economic situation. So there's all that, and then you're going to have a lot of points in the in domestic politics with primaries coming up over the next several months. Who are going to be the nominees? Will there continue to be rising third-party challenges, as I've thought and continue to think there will be? Exactly what is the direction of the United States, both domestically and in terms of its own foreign policy? Those will play out in specific points, at least once or twice a month through the year, and I think have the opportunity to put additional volatility into the markets as unsure about the future direction of the United States.
Terry, I don't want to be inflammatory. I just want to be smart here for our audience. When we talk about a third world war, when I look at our Bloomberg intelligence team and when they're putting out research when it comes to what we need to watch on the global economy, and top of the line or top of the headline is about war. So how do we need to think about the possibility of a third world war?
In some ways, and I'm not trying to be inflammatory either, I'll give you a different way of thinking about it, though. In a lot of ways, we already are. There are at least three regional conflicts. There's cyber war. There's a concern about how the contending parties move into space. There are concerns about how they're moved around even in the Arctic, for example. So you've got kind of a slow-moving conflict right now, and I'm not trying to be inflammatory or push it too far either. But what I will say is that anybody that's looking at the current three spots as solely regional conflicts and not representative of a larger conflict isn't thinking about this enough. And the economic consequences alone, as you all just noted, on supply chains and in the Red Sea and many other things, could be very substantial. So we are in a very volatile situation already, even though markets don't fully understand it, realize it, or appreciate it.
So there's a lot to worry about on the global front. Let's go back domestic, though, because you write in a recent note, you talk about Washington's out-of-control fiscal spending, increasing debt service costs. Maybe we saw some of those concerns play out in the Treasury market in the summer, but looking at the state of play right now, it seems like that was a blip. But what's the trajectory there when you think about the fiscal side of the equation?
Washington always thinks that they understand the markets, and the markets always think they understand Washington, and that Washington is responsive to markets. I've never thought that was true, and we've probably got the biggest gap between Washington and the markets in some time. Increasingly, markets are asking, when and whether the United States government is going to be able to get its fiscal spending under control, and there's no movement at all towards doing that. You have a situation in Washington right now where, the most the people who are banging their fists on the table the most to control spending are people that are, ironically, to some extent, conservative Republicans. But really what they're doing is talking about as much as 1% out of 30%, the discretionary part of the overall federal budget. And that's a blip, and that's by no means what anybody expects. So the discrepancy between what markets want in terms of more sustainable fiscal policy and what Washington it can deliver, there's a huge gap, and there's no indication that Washington even understands what markets want or expect there.
Terry, we'll have to see how these negotiations go down to the wire this month in regards to the potential risks. And as you say, there is a great disconnect between markets and Washington. Let them rule. We rule our own way, say the bond, equity and commodity traders. Terry Hens, Pangea Policy, joining us there with the very latest. Coming up in the next hour, Angela Stent of the Brookings Institution, right here on Bloomberg. For our audience worldwide, a very good morning. This is Bloomberg Surveillance, live on Bloomberg TV and radio. Alongside me, Carol Massar and Katie Greifeld. A very good morning. I'm Manus Cranny. So if you're not in, don't worry. You weren't the only one that got it wrong in terms of being long equities. Most of Wall Street got it wrong as well, and they're paid a lot of money. Equities are up 55% on the Nasdaq. The S&P 500 is just prevaricating 48.31. That was a bit of an unfair pop, was it?
Hate mail. Send it to Manus, not Katie and me.
You're okay. But that's why you paid 2.20 to the hedges. Okay, Nasdaq was up 55% this year, and if you weren't in Nvidia, you simply weren't in it. Nor Tesla, 105% relative to the rest of the automakers. So let's roll it over. Have a look at the bond markets. Do you go for breadth on the Russell 2000? That's the question.
That's what everybody's saying, right? Maybe? Yeah.
Small cap value.
Yeah, small cap value.
You two have been converted, haven't you? You just listened to enough people this week now. Although you did start the week with you wanted small caps.
Yeah, they've been so left behind. Everybody's been kind of talking about them. I feel like for some long time, they finally got a little bit of left.
But how much of that was pulled forward? I mean, you think about these 2 months.
All of it, right?
Yeah.
Not just small caps.
Exactly.
Let's have a look at the bond market, because how do we finish there? You were possibly tempted in to the auction yesterday. No, you weren't, because you left an awful lot of the paper with the dealers. You went, have a bit of indigestion there. One final auction in the 7-year paper did not go according to plan. Yields rise ever so slightly. Again, we have not retouched the lows of the mid-year point. We moved and pivoted with the Fed.
No 6%, though.
No, there's not. Jamie,
not even 5%.
Jamie needs to be careful. Corporate communications need to rein in the exuberance of Jamie Dimon and other people as well, who did say there's a risk of...
No reining him in, by the way.
We're just taking shots this morning.
No.
Jamie, you can say whatever you want.
I've got one thing. Now, Katie's dad has tuned in all morning, and this is a big shout out for Bob, by the way. Good morning. You're right. You believed Mr. Curry on the oil market, and it hasn't happened. $100 oil did not happen. I'm Rita Sen as well, so we do know that you're listening.
I did not know he was tracking the oil market that closely. We're all learning a lot about each other.
Dad, we could use you.
Hello, Dad.
You could join our booking team and our research team.
There you go.
Come on in.
He has some talking points to share.
I think that's the first moment we've actually made Katie blush this week. Anyway, there you go. So, Bob, keep the notes coming in. We'll take calls from you anytime. Let's get to under surveillance this morning. NVIDIA is selling a less powerful version of its best graphics chip to China. This is in order to comply with the U.S. restriction. The version sold in China has 10% fewer processing cores. The Biden administration is clamping down on exports of powerful chips to China, which has used to advance AI technology. The FAA is closely monitoring inspections of 737 MAX airplanes after the airline found a bolt defect in the rudder control system during routine maintenance. Now, Boeing is asking all of the operators to check newer single-aisle airplanes for the issue. Airlines across the world are also ramping up inspections of spare parts tied to AOG. Technics. That's after falsified records were found. No immediate safety issues have been reported in either case. And Cathay Pacific has cancelled some of the year-end flights after illness spread through the ranks of their pilots. Now, the airline is cutting 11% of the departures from Hong Kong. Flights have also been cut as their pilots hit their annual flying limits, according to Bloomberg. Services affected span Pacific, including Sydney, Taipei, Shanghai, and Singapore. So
everybody's getting sick right now.
There's no sickness on this show this week.
I just got over COVID. I mean, there's multiple people who've had COVID.
For somebody that's
recently.
just having COVID, you're looking pretty darn healthy.
So, makeup and hair.
Yeah, some professional help coming through for all of us. But normally we would chat a little bit about all these, but we have some real news to get to, and that is 2023. It was the year of Taylor Swift. And of course, her version of doing things has been a little bit different. She has innovative takes on everything from record deals to touring. But just how rich is Taylor Swift? Bloomberg did the math.
It's official. Taylor Swift is a billionaire.
Welcome to the Eras Tour.
Her Eras Tour alone is a party, generating hundreds of millions of dollars. It's a multinational conglomerate with the world's most devoted customer base and an ultra-charismatic CEO.
Never before have we ever seen an artist put multiple stadium shows on sale in the same city and blow them all out.
But how much of the money has gone into that CEO's pocket? We've crunched the numbers to come up with the most definitive account yet of Taylor Swift's wealth. And here it is. Bloomberg has a team that tallies up how much the world's wealthiest people are worth. It's based on careful calculation and analysis of all their income and assets.
Taylor has become a billionaire not just because people like her songs, but because of a lot of smart business decisions that she's made over the years.
Taylor Swift is a phenomenon, but she's hardly the first billionaire in the music industry. There's the record label scion David Geffen, there's Jay-Z, Rihanna, the late Jimmy Buffett, and plenty of others. While those billionaires use their fame as the foundation for other business ventures, Swift has made her fortune almost exclusively from her music.
She has really come out openly about the importance of controlling your music and owning your music as an artist.
So where exactly does her wealth come from? Let's start with streaming. The rise of Spotify, Apple Music, and others has created a resurgence in the recording industry.
We estimate that her total income from streaming is $175 million.
Clearly not a number to sniff at, but one reason it's not bigger is because of the way royalties are distributed.
Typically what happens is artists don't own the masters of their music, but they get royalties from it.
The owners of the masters generally keep 4/5 of the royalties, while the copyright holders, the composers and lyricists, keep the rest.
So what Taylor has done recently, and has been a very smart business decision, is to re-record her albums and then own the masters of those.
So with this re-recording exercise, she's kind of taking back control of her music. She's reclaiming ownership of it, but she's also diluting the value of the masters to the first 6 albums that are originally out there.
Swift also took the battle to the streamers themselves.
So in 2014, Taylor Swift pulled all of her music off of Spotify. She did it in protest of what she said was unfair compensation from the streamer.
That gave her the upper hand when she renegotiated her rates to join Spotify again in 2017.
She's also done a great job in promoting physical album sales online through Twitter, Instagram, other social media networks, so fans have an incentive to buy physical records.
She's leveraged social media and kind of connecting with fans, getting to know them on a personal level, sharing information about herself, kind of creating this intimacy, which has created this really, really powerful fan base who connect with her.
Bloomberg estimates Swift has made $125 million over the years from record sales. She also made strong strategic choices at the negotiating table.
In 2018, she left her longtime record label, Big Machine, to go independent.
She negotiated a new contract with Universal Music Group in 2018 that allows her to take a larger share of the royalties.
The biggest part of her earnings is undoubtedly her concert revenue.
Taylor Swift's concerts have generated at least $1.6 billion, and that is only ticket sales. That's not including merchandise.
She's done 6 tours over the years since 2009, most recently the Eras Tour. It came right as everyone was starved for live events. People were coming out of the pandemic and really wanted a chance to gather in person and celebrate.
And there are people that are willing to spend anything and everything to get a chance to see her.
A splurge for sure, but we're glad to do it.
We've just been trying without mortgaging the house.
Of course, she doesn't keep all of that money.
We estimate that Taylor nets about 35% of the ticket sales as profit, about $500 million from touring over the years.
Her tours, her record sales, and streaming royalties are all earnings, but she also has assets, including her recording catalog.
There's the master's rights, then there's the publishing rights. Catalog is a collection of songs, all grouped under one artist. Every time a song in this catalog is played, it generates a royalty, which goes back to the owner.
Swift doesn't actually own the first 6 albums of her catalog. It's now owned by a fund called Shamrock Capital. She's re-recording those albums, meaning she'll get both more streaming revenue and a more valuable catalog.
We estimate that her catalog is worth about $400 million.
Then, of course, there's her actual property.
That includes a condo and an estate in Nashville, an estate in Los Angeles, a large apartment in Tribeca in New York City, as well as a summer house in Rhode Island.
The Rhode Island property is interesting because it's not really a typical haunt for celebrities or pop stars. It's an old world, sort of old money part of the country, but it is kind of in keeping with Taylor Swift's image of this sort of girl next door, a little bit of a homebody. In fact, she's also has hosted fans there in the past and baked them home-baked cookies at this property.
Making bulk batches of chocolate chip and toasted coconut cookies for
the total value of her properties is about $110 million.
Subtract her expenses, taxes, staff costs, and so on, and you get a net worth of $1.1 billion. This was a huge year for Taylor Swift that tipped her into a new echelon. But with the 33-year-old having just set a concert film record and the international leg of her tour getting underway, she may only be getting started.
And you can find more Bloomberg Original Stories streaming in the Bloomberg app and online. And we'll have more on the world's wealthiest people coming up a little later in the show. But let's talk about Taylor Swift, because even if you're not a fan of her music, and I am for what it's worth, what an incredible businesswoman.
Yeah. And really kind of waking up the industry, right, in terms of standing up for musicians' rights, the people who actually create the music. You know, you go back through decades, people would write songs and they would lose the access or rights to it very easily. And it was really the record companies and so on and so forth that were in charge. And she really has changed the dynamics, although you remind us of George Michael.
Yeah, and that's probably because I just watched it on Netflix. If you go back to the 1980s, okay, he called his contract with Sony professional slavery. It was a huge court case in the UK courts. He lost. He lost his case, but he then refused to record for Sony. And it's a very poignant moment. He regrets the conflict, but it set the stage for global artists like Taylor Swift to be a lot more savvy, a lot smarter, a lot more aggressive about owning the rights to your music. The world has changed now. We're in a streaming world. He went on to work with Virgin, but George Michael in many ways set the precedent of understanding what did you sign, why did you sign it, and what do you own of yourself when you sign your life away to a record company?
And Careless Whisper, I mean, one of my favorite songs in the world. But yeah, I mean, Taylor Swift, it's also amazing how she's she's capitalized on this. You think about buying back her masters and then re-recording her songs.
Brilliant.
We all know these songs. We first heard them, 10, 15 years ago. Every release of these re-recorded albums has been huge. And she's also been releasing new unreleased tracks along with it. And it's become just hysteria every time it happens.
All Too Well just gets longer and longer and longer.
I'm waiting for the 20-minute version.
So
there will be a movie.
The barista at Starbucks, he said, he was making a coffee for me, and he said, yeah, he's just paid $1,000. He had paid $1,000 for the Eras tour. You just look at the breakdown: $400 million on the music release since 2019, $370 million in ticket sales over the years. And her personal properties. You like the properties, though, Carol? $110 million.
She knows how to buy real estate. I've seen the property up in Rhode Island. It's pretty impressive. Beautifully overlooking.
You inside?
No, but my daughter and I did stand in front of the picture.
Did you take a picture?
As the security guy said,
hey,
move along. What's interesting is this was a year where we really stood up not just those who loved Taylor Swift or loved her music, but the broader economic community looked at her impact that she could have. Sales of her tickets or sales of her
she caused an earthquake, a mini earthquake, physically.
But they moved actual companies that are in the live entertainment business or who sold tickets. I thought it was interesting talking about Beyonce.
Yeah.
We talked about Barbenheimer, right?
Yeah.
Adding, what was it, like $8.5 billion to U.S. growth in third quarter. This was a year where we really took notice of this.
Someone made the point, and I don't know if it quite stands up, but that when Taylor Swift's tour would come through town, it was basically like having the Super Bowl there.
Well, it changed the employment numbers. It helped inflation. It was a global phenomena. Coming up on the show, we'll talk a little bit more at 8:15 with Rich Kleiman from LaSalle Investment. Did he have the winning ticket on advising Taylor Swift on some of her property deals at LaSalle?
I love the fact that you've been using this term FOMO because it describes, I think, perfectly how investors have been rushing like mad in one direction, turned around and rushed into the other direction. We're all celebrating the fact that inflation has come down, although, I don't know how it's for you guys. Personally, I don't really feel that things are getting cheaper. Inflation at 3% seems great when you dealt with 10% a while ago, but 3% still means it's getting more expensive. It's just not getting expensive as fast as before.
Sonia Martin, DZ Bank, head of FX and monetary policy, keeping it real. There may be disinflation according to the central bank's data, but do you feel that your life is getting cheaper or not? One thing we are keeping an eye on is whether we can take out one last line in the sand and make a record on equities. 47.96.5 on the cash on the S&P 500 is where we really want to go. Futures at the moment still dipping slightly. 48.30 is where we are. The euro dollar is flat. It's the number 4 performer against the dollar this year. Treasuries, 388 incrementally. This week, we have just incrementally ticked higher through the week, 388. And we had a lot of auctions, which went well, bar the belly of the curve yesterday.
Yeah, of course, that 7-year auction not quite living up to what we got earlier in the week. But, I think everyone's...
unusual, you think? Is it just something to do with the 7-year, or is it just that maybe the week was coming to an end?
I think maybe it's mostly the week coming to an end. Of course, we think about the 2-year, the 5-year, seeing decent demand there. I think that a lot of people took that as a good signal. So.
Okay, we got a little bit of data today. We got the Richmond Fed. For the last day of the year, you get the Richmond Fed at 10 a.m. and the Dallas Fed Services a little bit later on. They are unlikely to really rock the bond market. But let's talk about rocking the world of the rich. It is the comeback year for the world's wealthiest people. Bloomberg's Christine Oram is with us. You put the list together. This was the comeback year for the rich. So Elon is there on the daily basis, $232 billion. Is he the winner of 2023? How did it stack up? Good morning.
Good morning. Thank you. It's safe to say Elon is the winner of 2023. It feels like a long time ago this time last year, but he was actually not the world's richest person at the end of 2022. Bernard Arnault, the CEO of French luxury brand LVMH, was. He could surpass Elon because of the rout in tech stocks. And that didn't last very long, though. Elon very quickly retook first place. They were neck and neck for a while, but now he's back in first. He added about $95 billion to his wealth this year alone. Now, that sounds like a tremendous amount of money, and it is. But if you could look at last year, he had actually lost about 140 billion last year. So he is not back to where he was at the end of 2022, despite the rebound in the stock market. But he has retaken his place.
And I love the headline that the combined net worth of the 500 richest people surged by $1.5 trillion in 2023. So they rebounded from a $1.4 trillion loss the prior year. So they're even. I'm really happy. Yeah. Hey, let's talk about Jeff Bezos as well. You can't talk about the billionaires without kind of wanting to know how he did this year.
Yeah, so basically, as you say, it's almost like 2022 never happened. They've essentially regained all the wealth they lost during the market wipeout of 2022. Jeff Bezos has been another very big winner. He is actually now vying for second place with Arnault. He's very, very close. He actually briefly took second place earlier this month. He's added about $70 billion in wealth this year. Again, pales in comparison to Musk's $95 billion, but I think any of us would be happy to look back at 2023 and say we are $70 billion richer. For him, it was purely the rebound in Amazon. And this has kind of been the story across the board is that, as you guys talk about all the time, the NASDAQ has been very strong this year. Tech stocks are back to records, more or less. And so all of the tech billionaires have benefited from that. Mark Zuckerberg is another one. If you look across the board at all tech billionaires, they added about $660 billion in wealth this year. So nearly half of the gain in total wealth across the 500 richest people in the world was for tech billionaires.
It's interesting. We've talked a lot about how market strategists didn't get it right this year. Who would have foreseen that maybe, if it hadn't turned out to be such a kind of risk-on trade, certainly in the second half and later this year, whether or not this would be how the list would have played out, whether it would have been a much more difficult year. So having said that, let's look ahead to 2024, because I feel like the conversations we've had with guests, there's a lot of different scenarios that could play out, and that's certainly going to affect some of the billionaire wealth in the new year. How are you thinking about the new year and who we should be keeping on our radar?
Yeah, you're right. I mean, I don't think anyone at the beginning of 2023 would have guessed that essentially the world's people would have regained all the wealth they lost in 2022. We were worried about a recession, inflation, high interest rates, but none of that ended up mattering in the end, at least not for the wealthiest people. Looking ahead, of course, it's so difficult to predict as it was for 2023. But when you think of some essential names to watch in 2024, one of the first ones that comes to mind is actually a woman who hit $100 billion in net worth. First time yesterday. This is the first woman ever to reach a 12-figure fortune. That's Françoise Bettencourt-Meyers. She's the heir to the L'Oreal fortune. Her grandfather founded L'Oreal. Her mother passed away in 2017, passing that fortune on to her. She's an extremely private person, not seen in public very much, definitely doesn't do the red carpet circuits, but she is now the world's richest woman, the first woman with $100 billion, a real beneficiary of the strength in luxury stock, even though we've seen a bit of a slowdown due to the disappointing economy in China. L'Oreal has really outperformed. It closed at a record high yesterday, and so she's been a major beneficiary of that. Another woman to watch is Miriam Adelson. She recently bought the majority of the Dallas Mavericks. That deal is expected to close this week, actually, from Mark Cuban. She's the first woman to own a major sports team, and she's clearly stepping up her involvement. She's been talking about potentially supporting Nikki Haley in the 2024 election, and so she's clearly getting more involved in politics, in spending her money. She is the heir to the Las Vegas Sands fortune. She inherited that from her husband, Sheldon, who died in 2021.
Let's talk about another sports owner. It was interesting to see Steve Ballmer on this chart of some of the richest people out there. Of course, he is the owner of the Los Angeles Clippers. He's also the former CEO of Microsoft. And unlike some of the other people included in this chart, I mean, Musk, Jeff Bezos, Bill Gates, I feel like we hear from them a lot, but not as much from Steve Ballmer. And yet his wealth has grown pretty steadily throughout the course of this year.
Yeah, absolutely. I'm just pulling up his net worth analysis here. So Steve Ballmer, he's the fifth richest person in the world. And as you say, not someone we talk about nearly as often as his other tech billionaire peers. He has a net worth of about $130 billion. He owns the LA Clippers, but the vast majority of his wealth comes from his Microsoft shares. So he's no longer at the company, but he still owns about 319 million shares of Microsoft. And, needless to say, Microsoft, along with Amazon, has been another tech stock that has really benefited from the rebound this year. In fact, Microsoft, the rebound has largely been attributed by some people to all the hype around AI, all the excitement around AI. And Microsoft, of course, is very closely involved with OpenAI, the creator of ChatGPT. And so they arguably have been one of the biggest beneficiaries of that hype cycle. Steve Ballmer, he personally has had nothing to do with that, but by holding this big chunk of Microsoft shares has been a big
lucky for him.
Indeed. Yeah. Christine, obviously cross assets, we've talked a lot about tech, but there's a flip side of that, which is a lot of boats rose this year. Bitcoin was one of those. Crypto was a strong year. Now, there's one name who was the CEO of Binance. We're talking about CZ. He pleaded guilty to money laundering, didn't he? But we did see his wealth continue to rise.
Yeah, he is a very interesting case. And this is a conversation I've had with the reporters on my team about how should we really be thinking of CZ's wealth. But the point is, Binance is still doing quite well. It's still the largest crypto exchange in the world. Its trading volumes are still quite high. We'll see if that changes going forward. But despite the fact that CZ and Binance have both pleaded guilty to money laundering, to violating U.S. sanctions, and the fact that CZ may potentially even be headed to jail in 2024, his net worth rose by almost $25 billion in 2023. And that, arguably is not because of anything he did personally. It's just because of the comeback in crypto markets. And Binance has been, a major beneficiary of that. So even though this is someone who has a criminal record now, may potentially be headed to prison, he's getting richer and richer.
And of course, as we go into the election year, there's one name we didn't cover. It's Donald Trump. Since he left the White House, his wealth has grown by $500 million since 2021, a total of $3.1 billion. Which does he want? Power or money? That's the question that goes through my mind.
I would say both. Not me, him.
Power and money sounds pretty good.
That's pretty intoxicating.
Katie's like, I'm all in.
It's the perfect combo. A little bit of power and a few dollars to spend. What more do you want? Christine Oram, thank you so much for being with us. Coming up on the show, Chuck Lieberman of Advisors Capital Management joins us to set out the stall for 2024 and reflect on 2023.
Power gives you money. Money gives you power.
Symbiotic relationship.
We think rates are going to continue to decline as the Fed normalizes policy.
I think the risk is to the downside in overplaying these Fed rate cut expectations.
We probably still get 3 to 4 rate cuts next year, but they don't start until later in the year.
It's really difficult to justify, based on the data, the hawkish rhetoric at this point.
Right now, I would be fearful because others are greedy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
And a very good morning, everybody. 90 minutes away from the start of trading here in the United States. Will we see a record for the S&P 500 in this last trading day of the year? We shall see. We're not too far from it. 1 week from today, mark your calendars. We're going to be awaiting a monthly jobs report in the U.S., which will just set off that narrative about the U.S. economy, U.S. Fed policy. That will certainly carry on into 2024. Before that, we have global shares on track for their best annual performance since 2019. As I said, a very good morning from New York City for our audiences worldwide. This is Bloomberg Surveillance live on Bloomberg Radio and Television. Alongside Manus Cranny and Katie Greifeld, I'm Carol Massar, already starting to think about the year ahead and what we're going to be talking about next week as we start to get some Fed minutes. We'll have that jobs report.
It's a pretty beefy first week back. It helps you set out the stall. I don't know whether it's going to be a rerun of 2023, where we came in. We did 6% in January. We did 16% or 13% by the middle of the year. And it was all eyes down on China, all eyes down on a full bull on oil. And we've already had one sentiment this morning, which is run your longs. I liked what Sam Stovall had to say, which was run your longs. If you're doing well, run like the bulls in Pamplona.
Let your winners win, And you think about the winners this year, obviously big tech back on top. You take a look at the underperformers. It's interesting. It's utilities, it's energy, it's staples. Some of those more defensive plays that maybe you would have thought would have done pretty well, maybe around the summer especially, but those are your biggest losers.
Well, and as everyone is saying, as Sam said, let your winners run. At the same time, we are hearing our guests say, wait, you got to continue to let it broaden out. There's some really great opportunities among the rest of the S&P 500 and some other names that are out there that have been unloved or underloved.
It's interesting how we had like go to tier 3, which was from NVIDIA 280% return to get yourself some Broadcom tier 3.
Yeah.
But, you know, Broadcom
Perspective.
did 100%. But if you had Tesla relative to GM, relative to Ford, you were still looking at, what was it, Tesla 105%, Ford 6%, and GM 7.6%. So the disparity between the haves and the haves not is monstrous.
Well, did you guys see this fun story on the terminal? Abercrombie is a sleeper hit this year. It's up like 300% this year alone. That is more than NVIDIA.
I'm too old to wear Abercrombie now.
That's cray-cray.
Let me
I
tell
actually
you.
need lights in shops when I go into them so that I can actually see the stock on the shelves
You
rather
don't
than
like
sort of,
walking through a thick cloud of cologne.
Yeah. Well, it's when you walk past the model at the front door, you just sort of go, that's not
for me.
That T-shirt's not going to look like that on me.
Yeah, sorry, NVIDIA, I did better.
I don't know, but it has been pretty amazing to watch Abercrombie. And there's a ton of these sleeper hits, you know, these underappreciated, undercovered company stories, even as we've been focusing on the Magnificent Seven. They're out there.
Dare I say stock picker's market?
You could say that. A lot of people have been saying that.
Active management. I mean, look, this is what it's going to come down to, isn't it? Whether we have much more active, the deployment. We've talked about it, $6 trillion in money market funds. How much of that gets pivoted into active management or fund tracking, the ETFs?
Well, you know, the ETF world, we're seeing much more introduction of active ETFs.
You are, actually. You take a look at both the inflows and the new ETF launches this year. It's a lot of active management. Now, a lot of that is going towards passive-like active management.
But I was going to say, how active is it? And what is passive like?
Is that like being a little bit pregnant? You're either are or you're not. You're either active or you're passive.
No, it's like putting on, you know, maybe in options overlay strategy, things like that.
You cannot. You're either one or the other.
I'll try to think about analogies to pregnancy, but I'll work on that one.
I might have that.
Well, you work on that while I get some air and oxygen for Manus. Let's take a look at the market setup, shall we, on this Friday, last trading day of 2023. No surprise, pretty quiet there. You're seeing a little bit of a movement to the downside when it comes to S&P 500 futures, just down shy of 3 points, 48.29. So will we or not get to 47.96.56 in the regular trade? We shall see. Quick check when it comes to the 10-year, 3.87, excuse me. So just up a hair on this Friday. All right, let's get to it. You've got kind of your market setup. It's another quiet day, no surprise. Chuck Lieberman is with us. He's co-founder and CIO of Advisors Capital Management. Joining this, Chuck, nice to have you here. You're not expecting a recession, are you, in 2024?
No, I haven't been looking for a recession in 23, and I don't see one on the horizon even in 24. Most of the economy is doing too well.
Well, Happy New Year sounds like, or almost a Happy New Year sounds like it might be. So what does that mean then for Fed policy, where we've had a fair amount of guests who seem to be dialing back kind of their expectations for a very aggressive Fed this year? How do you see it?
I also would suggest that they're not going to do anywhere near as much as the market's priced for. As long as the economy is doing really well, they can sit back and wait and let inflation come down or let data come in to show that the inflation rate is coming down. It's questionable whether it really will come down as much as they need. They still have the 2% target. We're not there. There's every reason to expect inflation will be harder to bring down if the economy is doing well. The unemployment rate is low. Job growth is still very solid. The labor market's not getting looser, so wage inflation is not going to dissipate. So it's really hard to see inflation coming down as much as the Fed needs to be able to justify a whole series of rate cuts, which is what the market's priced for.
So if you think the wage, I mean, look, just one pillar of your thesis, Chuck, good morning, it's Manus, is that wage inflation will remain high, it'll remain sticky. If corporate profits are high, there'll be enough pushback from employees to get those wage rises. But with that in mind, then the jobs of the Fed in the very, very near term is to reinforce higher for longer. And the consequence of that will be what? Will you be the one person that will come on this show this week and say that you expect the S&P 500 to dip or drop or, I don't know, I'm not talking about a correction or a bear market. I'm not trying to talk you into that. But could we see a slight drawdown?
Well, the market is volatile. It's a roller coaster. So it takes very little to trigger a downdraft. You look back historically, there are downdrafts multiple times every single year. So that would not be a surprise at all. And you don't need data to justify it. You just need a little bit of concern for any reason whatsoever. And the market historically has done that. So That will happen. It'll happen multiple times in 2024. But my sense of it is that with rates staying where they are, no change in policy, at least for the first half of the year, with the economy doing well, all of that justifies higher stock prices, especially since the S&P 493, as Carol suggested earlier, is unloved. It's really good value.
Well, not to sound too negative, but if there were something to worry about, what would it be? You know, you talk about the Fed, you talk about the economy, certainly still on solid footing, and it's your expectation that it will continue to be. Rather, what is the risk out there when it comes to sentiment then?
Well, the major risk in almost every case is that the market gets disappointed. And the big disappointment to the market, given how it's priced, would be if inflation doesn't come down, and even worse, if it ticks up a little bit. That would send out a fear signal that maybe the Fed needs to raise rates at some point in 24. I wouldn't dismiss that possibility. I think that's a real possibility. So I think there's every reason to think the market will get frightened at some point over solid economic growth. For a while, solid economic growth was considered good news. At some point, it's going to be considered bad news.
So a risk that the Fed could actually raise rates once again. Interesting to hear you say that, since consensus seems to be that the Fed's next move, no matter what, will be a move lower. And with that in mind, those risks in mind, what is your all-weather bet here? What do you think will perform well in any environment when it comes to, you know, sector levels?
So I'm one of those guys who thinks that with technology having done spectacularly in 23, that the real value is elsewhere in the market. And there are a lot of companies that are cheap. When you look at the S&P multiple, that includes the Magnificent Seven, and those are in the ballpark of 30. Everything else trades a couple of percentage points lower in multiple. So that's where the real value is. And if the economy does what I think it'll do, then corporate earnings will do well. Those companies will do well. Those are the cheap stocks. And I include things like financials. The banks got pummeled because of Silicon Valley and the ripples that had in the market. That's a very cheap sector. Energy is cheap. The world still needs energy. A solid economy in the U.S. means some upward pressure on oil prices. Those companies will do fine. Financials in general, the insurance companies are all cheap. Real estate, the world is worried that higher interest rates are going to pummel the real estate sector. But housing is a really interesting one because this past year, we've seen rates go up, at least earlier in the year, and the housing market stabilized. And
well, some people would say that was possibly an inflation hedge, a lack of supply. It was a myriad of issues, and perhaps not enough turnover. Let's see what happens in the new year. We've got 1 minute left. I just want to get your call on bonds. We've had quite a dramatic drop in yield. You're out there on the anti-consensus that we may see a rate hike next year. You say bonds appear to be fully priced or even expensive. So do you expect some kind of retracement in sovereign yields given the outlook you've just given us?
Yeah, precisely. Because if inflation doesn't come down very much, then 10-year treasuries are too expensive. The yields are too low. You're not really earning very much of a return. So I think they'll see some negative price movement, but probably not enough to offset the coupon. So I think investors will earn a positive return, but a minimal return, a negligible return. The market expects the Fed to ease monetary policy. If it doesn't happen, they'll push that forecast out into 2025. And so I don't see bonds as a great place to be. I think they're a safe place to be, but not a great investment.
Do you think that all that money that we've talked about with Katie sitting on the sidelines, all the money in money markets, is going to go to equities ultimately? And just got about 15, 20 seconds here.
Yeah, I think most of it will. The stock market, again, there are many values in the stock market that are exceptional. So you can buy good companies, good earnings growth at 10 times earnings. That's just the place to be.
All right. So appreciate it. Listen, Chuck, have a great new year. Happy New Year. Chuck Lieberman of Advisors Capital Management. Yep, be well. All right, if you're just joining this program, let's get a quick check on how the market is setting up for this last trading day here in the United States. And futures have been very quiet all morning long. Right now, we're looking at a print of 48.31, just down about half a point. So what does that mean? It is down 0.01%. So having said that, I don't know if we'll get a record. We'll see whether or not, investors, I don't know if anybody's around at this point. It does feel incredibly, it's been quiet all week. I did feel like there was a little bit of momentum during the middle of the week and some stuff going on. But it does feel like it's trailed off.
Interesting call that he thinks quite a contrarian call. I haven't had anybody on recently that says the Fed may well have to hike. Or I think maybe the more potent part is delayed cuts through 2025.
Right?
Well, that was the key risk that the Bloomberg economics team put out, is that core PCE could bump higher, and that could destroy some of those big rate bets that we have out there on the forwards, that we're going to get these monster cuts.
And you think about what could upset the apple cart here. Obviously, it feels like everyone has piled to one side of the boat, all in on the Fed having to cut multiple times. If we get that inflation tick up, is the Fed either has to hold steady for longer than expected, or even potentially raise rates again, that obviously would cause some drama.
Well, we talk about the lag effect, right? And policy, it's not exact in terms of what the Fed does and then the impact it has ultimately on inflation in the economy. So this is something, that's going to be tricky as we get towards the tail end of this cycle here. And is the Fed going to be willing to risk maybe a deeper recession or economic impact to make sure inflation is done here in the United States, versus maybe starting to cut rates and then start to see it tick higher?
Well, don't forget, we all got so excited with the core PCE, the annualized core PCE being sub 2%, and that's where that sort of, torch.
That was exciting.
That was exciting. Do you get excited by core PCE?
Yes, of course we do.
Some core PCE
Bombos
right now,
do.
actually. That's true.
All right, guys, we're going to continue on the markets. We're a little bit under 90 minutes away from the open here in the United States. Coming up, I know I'm counting it down. It's coming. It's coming. Rich Kleiman of LaSalle Investment Management. We're going to talk some real estate. This is coming up. This is Bloomberg.
I do think the Fed is going to be losing that race in terms of who cuts first. I think the US definitely in the soft landing camp, but for Europe is a bit mix and match right now. Overall, I think we need to focus on the fiscal side in Europe. It's really difficult to justify, based on the data, the hawkish rhetoric at this point.
All right, that's Jeff Yu, BNY Mellon's senior market strategist, talking to us yesterday on Surveillance, giving us some perspective in terms of a soft landing and looking at Europe specifically. Having said that, we do want to get a quick check on what's going on in the markets as we get ready to wrap up the 2023 year of trading. Having said that, just a little bit lower on the S&P 500 in terms of futures, just down about 3.25 points, down 0.07%. Looking at the euro dollar, 110 to the euro there on the U.S. currency. 10-year note, we've been talking about it throughout the morning as well. A little bit of an uptick that we've seen throughout the curve, the U.S. curve, 387 on that 10-year note, way off some of the levels we were talking about earlier in the year, 5%, 6%. But here we are at 387 on this last trading day of 2023. New York crude, a little bit higher, up about 0.7%. We saw a rally earlier in the week, but right now, on this Friday, 72.26 a barrel. We do want to talk a little bit about real estate, because this has certainly been front and center, really coming off the pandemic, when we are thinking about, especially when it comes to commercial office properties, how do we use real estate specifically? Curious what Rich Kleiman is seeing. He's America's head of research and strategy over at LaSalle Investment. Rich, good to have you here with the team. You guys are a big global company, $89 billion in assets under management, 13 countries. You've been around for a while. This real estate environment, go back to 1968. This real estate environment, commercial real estate environment, how would you describe it? Where's the strengths? Where are the weaknesses?
Yeah, as we end 2023, it's been pretty quiet on the commercial side, just not a lot of trades happening. But hopefully as we get into 24, things will pick up. In terms of where things are more exciting, it tends to be in the residential sectors as well as industrial. Retail actually has made a nice comeback in 23 as investors start to circle what are the better properties there. And then, office remains kind of the one that grabs the headlines with the challenges over the last year plus now at this point, just with some of the occupancy challenges and then how investors are kind of staying away from that space.
All right, staying away from that space. Are we still waiting for some shoes to fall, for some dramatic fallout, or do you think that's been overdone?
I think we are waiting for some shoes to fall. Just the process of distress playing out in the office market has been slower than I would have expected, slower than I think many would have expected. I can kind of guess there are a lot of negotiations going on behind closed doors between lenders and borrowers in the U.S. office market right now. Perhaps in 2024, we'll start to see some of that kind of bubble up to the surface and see more trades, some of which could be at really attractive pricing, but I think time will tell in terms of where that actually plays out in the coming year.
And you say, Rich, that this distress level that will come in 2024 can provide high risk and high reward. We talked a little bit earlier in the week in LA. There was a building there, a huge building that went for 55% lower than its 2018 asking price. So what goes through my mind is, are we going to see some kind of bloodletting in the commercial property market? Is that a canary in the coal mine, or is that idiosyncratic to LA? It was near Century City, near Beverly Hills. I've never been to LA, so I have no idea where the geography of that is. But it's down 52%. Now that strikes me as something brutal. Will the price adjustment next year across commercial property be anything like 20%, 30%, or is that just too much?
Well, it's too much if you look at real estate overall, commercial real estate overall. There are some property types that are really holding steady or steadier. I think everything's down a bit with the higher interest rates if we look back kind of to 2 years ago or something like that. But situations like that of an office building in a market like LA, that doesn't surprise me that it's down that much. Obviously, I think we're going to focus on the stories that are the biggest numbers, the most eye-popping numbers. And so LA office, that's one of them. I was in New York a couple of weeks ago, and there was a lot of talk about what's going to happen with New York office, and that's another segment that is going to grab some of those headlines with some price declines, and we'll see. As
what kind of price declines do you think that we'll get in New York? Let's hone in on my new home city. What kind of price declines are we going to get? And we're going to see a step up in conversion from commercial into residential, which is sort of one of the big sort of feeds on my Instagram, which is get ready to sign on for this new apartment block. So price and restructure.
Yeah, I think the conversion story probably is a bit overdone when we look at it at a macro level across real estate. It's hard to convert office buildings to residential, especially downtown office buildings, especially those built, kind of between 30 to 20 years ago or so. So that story is probably a bit overdone. In terms of price declines in New York, the interesting thing about real estate is, every building has got its own unique story. 50% off of peak pricing, it might be a kind of nice landing spot for kind of, I'd say, average commodity buildings. There'll be those that decline much less in pricing. There are some buildings that are sort of top of the market that are seeing some still strong tenant demand. And I think investors are going to want to go into those first if they can find opportunity to pick them up at attractive pricing. And then there are those that might just be completely obsolete. And you're going to have to go down to land value, basically, which is sort of that conversion pricing. And that's going to vary a lot depending on what those alternative uses might be for any specific corner, any specific building or structure in a market like New York.
Really quick tangent. Actually, the first apartment I rented in New York had been converted from an office. When you opened up the closets, you could still see the original office flooring. But that was on the Upper West Side.
Did you like it?
I loved it. Okay. Yeah, that was on the Upper West Side, though. That wasn't in the financial district, where obviously there's different constraints. But we've talked a lot about office. Let's also talk within the umbrella of commercial. What's going on with retail? Of course, it's the holiday season. We've been talking a lot about the shift from brick and mortar shopping to online shopping. What are you seeing when it comes to retail specifically?
Yeah, it really feels like the retail market has withstood the worst of the stresses. The pandemic was such a shock in terms of everyone shopping online. And I think, before the pandemic, there was a little bit of a question mark of, are people going to grocery shop online? How much of that business is going to go online? And I think we saw a widespread experimentation with it, and people went back to the stores. We also saw a lot of retailers kind of realize they didn't need maybe 7 stores in a market. They could get away with 3. And so they consolidated to the 3 best centers in a market. So once we kind of enter 2024, we're sort of in this place where I think investors and retailers know which centers are strong and which ones they don't want to be at. And so, those strong centers are really positioned to do well in the coming year. There's no oversupply in that market, that's for sure. And demand is there, and tenants are willing to pay to be in the right center for them.
Well, put some more detail there. Where are the strong centers right now? Where are you seeing that strength?
Yeah, so, for us, the number one space we're seeing that strength is grocery anchored retail. Those centers often have a grocery store and then some local service type retailers, maybe a Starbucks, maybe a Chipotle, something like that, fitness establishments, hair, nails, that kind of thing. those really are e-commerce resistant. And so investors have certainly been trying to target those. And then, as you get into kind of the big cities in the U.S., there might have been 7, 8, 10 malls in the market. It's going to come down to 1, 2, maybe 3. And so those best malls are really well positioned right now, and whereas the ones that are sort of at the bottom are not doing well.
Bloomberg.
And then we see.
Oh, go ahead, please.
I was going to say, in kind of that in-between space, power centers, big box retailers, the better centers there are also well positioned. There's been strong demand. A lot of earlier this year, Bed Bath & Beyond went under. A lot of those stores are getting backfilled if they're in the right center. And if they're not, you'll still see them empty.
Just looking at the Bloomberg Regional Mall Index, it has rallied almost 40% since early October. So we've seen quite a bounce back. Really quickly, just got about 30 seconds here. A lower rate environment will be very, very helpful for the real estate market next year.
Certainly, we've seen REITs rebound. You mentioned the mall rebound. As interest rates came down from those peaks sort of in October, the REIT market went up a lot. In the private market, there's always a bit of a lag. But I think as we go into 2024, we're certainly optimistic that the rate declines is going to help bring a much healthier market than what we might have expected as, kind of a couple of months ago.
All right, we'll be watching it very closely. Hey, Rich, thank you so much. Happy New Year. Rich Kleiman of LaSalle Investment Management. Really appreciate his time on this Friday. But yeah, we've seen kind of a bounce back, certainly it feels like every asset class since either early or late October. But it'll be interesting because I think the office property is still a big question out there. And I kind of keep waiting for something to come undone here.
I think when I arrived, it was peak New York rent, that is for sure. Rents have dropped by about 10% since I arrived in the city. So there you go. There's your call. Peak rent, I called it. I paid it. I paid it with no incentive.
Not peak oil, but maybe
peak Manus rent. Yeah, you can call a market anyway.
All right, coming up, everybody. Bloomberg Steve Mann on the outlook for EVs. That's coming up next right here on Surveillance. This is Bloomberg. And a very good morning, everybody. This is Bloomberg Surveillance live on Bloomberg Radio and Television. Alongside Manus Cranny and Katie Greifeld, I'm Carol Massar. Quick check on the markets for you on this Friday. Little change, a little bit lower on the S&P 500. Trying to see if indeed we can see the S&P came close to a record yesterday. I don't know about today. It's very, very quiet. Call it unchanged, just a little bit lower, 1 point to the downside, 48.31 on S&P 500 futures. We've been talking about it throughout the morning. Some support there in terms of yields higher on that 10-year, 387. And New York crude, pulling off some of the earlier gains, right? Call it pretty much unchanged here.
I would call that flat. You think about the volatility in crude. I do have an exciting size and scope for you guys when it comes to the S&P.
I'm still thinking of the Abercrombie and Fitch story. I'm kind of like blown away, but go ahead.
But the S&P 500, if we do finish today higher, or at least a little bit higher, this would be a 9th straight week of gains for the S&P 500. I need to check.
That's a momentum line.
Exactly. I need to check the size and scope on the longest swing street there.
The big kind of criticism of that everybody has given us is you've got to think of the other 493 stocks apart from the Magnificent Seven. But the Magnificent Seven are going to see an earnings bump next year up over 20%. So it still justifies them being very much part of that narrative.
If the fundamentals are there, why shouldn't they continue? All right, let's get to some of the other headlines on this Friday. Under surveillance this morning, Man Group is considering more acquisitions and a private credit push as the asset class continues to gain appeal among investors and money managers. According to Man Group's head of discretionary, the hedge fund plans to expand into different credit strategies in coming years to meet rising demand from clients and capitalize on the shift in corporate borrowing habits. Oh, yeah. This could be, once again, we're going to be talking a lot about private credit. Every time we go to Milken, the global initiative on the West Coast happens every spring. I always think, oh, public markets. No, it's all about private credit, private lending.
And you wonder there, I mean, the returns, you look at private versus public, you've gotten pretty good returns in public markets right now. And you have to think, of course, when you see all these stories, is it worth it to go private if you're an investor?
Well, the whole world seems to be piling into private credit. We kicked off Bloomberg Brief, the 5 a.m. show with Glenn August at Oak Hill Advisors, and it was just this sort of evangelist moment with Schwartzman. I mean, Robin Grew, who runs Man, She's new to the role. She's a formidable lady. I spent time with her in London in June. And this is what she said to Francine when she caught up with her. You should tune in and watch it on Leaders with Lacroix. The next 5 years are going to look a lot different to the last 5. It's going to be a massive opportunity. So she wants to make her stamp. She wants to make her mark. And that pullback from banks on higher rates is going to impact. So she's on a mission, I would say, to put her stamp across man. So good luck to you. Find the asset and do the deal.
Our big take on the Bloomberg last week, big banks copying from private credit's playbook. Man, the big names on Wall Street, they're getting into this. All right, on the political front, we've got a story. Maine Secretary of State has ruled that Donald Trump cannot run in the state's Republican primary. The ruling marks the latest attempt by opponents to keep Trump off the ballot for his part in the January 6th riots at the Capitol. The Trump campaign saying the decision is politically motivated and is planning to appeal. Again, we talked about this earlier. I think there's a lot of uncertainty as to how these ultimately play out. Who decides really that he can stay off the ballot? But I feel like there's going to be a lot of legal wrangling to figure that out.
A lot of legal wrangling. We do have a blueprint of sorts when it comes to Colorado. Of course, he still is on the ballot in Colorado during this appeals process. We'll see how this shakes out in Maine, whether it follows that same playbook.
Well, their campaign, the Trump campaign, saying, look, this is the attempted theft of an election via disenfranchisement. Again, the language is very normative from the Trump campaign. And that's where we're going to go. There's going to be a series of these challenges. Supreme Court is going to be heck busy in the first quarter of 2024.
It's a different territory for all of us here in the United States when it comes to U.S. elections. So following this very, very closely. Also watching very closely what happened to the dollar in 2023, set for its worst year since 2020. Much of the decline came about in the fourth quarter as investors increased bets that the Fed would cut interest rates next year. Yes, indeed. The Bloomberg Dollar Index set to close down nearly 3% this year, its steepest annual drop since the pandemic. We understand why the move is happening, but there are implications when you have a weaker dollar.
Yeah, big time. You think about, the read through to commodities, for example. Manus, I know that's where your mind is. And also, of course, I said this yesterday, FX is fun because it's a zero-sum game. So you have the dollar having a terrible year. You have the pound having a great year, biggest annual gain since 2017. The franc up the most since 2010.
Yeah, we just got to see whether the SMB will tolerate that level and that strength. Of course, they moved their language last week, but up 10.3%. That is what you call a pretty significant gain.
For FX, too. You don't often see those types.
We need our own FX show. That's actually what we need.
Who would tune
Producers,
into
are you
that?
listening?
There
Manus has a pitch.
There you go. I've got more time on my hands. Okay, let's talk about this year because the United Auto Workers strike. Remember that? It was against GM, Ford, and Stellantis. It came at a pivotal moment. This was as President Joe Biden pushed the U.S. towards its climate goals through the Inflation Reduction Act. The electric vehicle revolution will transform the market and the role of labor itself. It'll face mounting competition from the likes of Tesla and China. The union car makers alike are fighting for their future.
It's time to stand up against corporate greed.
That's Sean Fain. He's the head of the United Auto Workers. He's not happy. Why? Well, his members are worse off, and there are fewer of them than just a few years ago. And a new threat is looming in the form of a technology that is crucial in the fight against climate change, which unions fear will lead to even fewer jobs and lower pay: electric vehicles.
If you think about an electric vehicle, it's a very simplified vehicle, right?
An internal combustion engine can have as many as 2,000 moving parts, while an EV powertrain has as few as 20.
It takes 40% less labor to assemble, so that means there will be fewer jobs in those areas.
Now they want to go all electric and put you all out of business.
EVs in the United States still account for fewer than 1 in 10 auto sales, but that is expected to change dramatically. And by 2030, President Biden would like half the vehicles sold in America to be electric.
You've earned a hell of a lot more than you're getting paid now.
So Biden is walking a tightrope between his self-declared most labor-friendly president ever and his green agenda.
Electric vehicles and alternative fuels will be pivotal in humanity's struggle to lower emissions. The fight now is over how long the transition will take and who will pay the highest price.
And you can find more on Bloomberg Original Stories, streaming on Bloomberg app and online. Let's continue that conversation about the automakers. Steve Mann, automobile and industrial analyst for Bloomberg Intelligence, joins us now. We spent a lot of time this week talking about Elon Musk, his wealth. We've talked about the various companies that Cathie Wood is backing. Tesla is still very much part of that. Steve, talk us through where Tesla is in pricing, because month after month or quarter after quarter, we spent time reporting about price cuts at Tesla. Is that to sustain market share? Is that to build market share? Or is that a company running in fear?
Well, I think it's not really to build market share. I think Tesla's market share will continue to decline as more competition comes into the market. You know, for example, GM is actually launching a slew of new EVs next year. Ford, less so, Stellantis, a few more. But you know, if you look at the luxury German luxury automakers, they're also launching some new EVs. So inevitably, market share is going to decline. I think what they really want to do, what Tesla really wants to do, is try to maintain that scale. They have invested a lot in their factories. You talked about, you know, the increased labor costs. They've invested a lot of robots. They've invested in a lot of automation. So, you know, they're trying to drive capital efficiency. So at the end of the day, you know, what Elon Musk is trying to do is keep scale and maintain a steady profit margin.
But let's talk about demand for EVs, because it's not just Tesla. You think about some of the traditional automakers coming in here, but then you have the likes of Ford, for example, cutting back, scaling back EV production. Is the demand there for EVs in the way that, you know, some of these automakers thought it would be last year, a couple years ago?
I think, well, definitely demand has come off. If you look at the prices of EVs, it's actually, on average, is priced above a full-size pickup truck. So it's relatively more expensive today. But I think the IRA, you were mentioning the IRA, the Inflation Reduction Act, I think the whole purpose of that is to reduce the cost of EVs. But that's unlikely to come through until 2026 and beyond. Because right now, what the U.S. needs to do is build up the battery supply chain. The battery is the most expensive component in an EV. Right now, it's about 25 to a third of the cost of the EV. So, you know, if we're not going to use Chinese batteries, there's really nowhere else to go. But the only option is for the U.S. to build up their own battery supply chain. And that, again, that won't come through until 2026, 2027.
Well, to that point, I mean, EVs are expensive, batteries are expensive, and range anxiety is also really real. You know, if I'm going on a long car trip here, am I going to be able to charge? And to that point, how much time do you and your colleagues at Bloomberg Intelligence think about hybrids, for example?
Hybrid's a very good option, and I think it's a, you know, this whole transition is an evolution. It's not an overnight thing. So hybrid is a very good option. It does not only address the range anxiety, but also address the affordability. You know, that's a big issue with interest rates a little bit higher than they were, you know, before COVID. So, you know, PHEVs or plug-in hybrids are actually relatively on par now with the internal combustion engine vehicles. So affordability is an issue, and I think it'll be a good transition to 100% battery EVs.
You know, all right, Steve, we're going to leave it on that note. Listen, thank you so much. Steve Mann of Bloomberg Intelligence. Appreciate you checking in. You know, I was just looking at some stats, you guys. I mean, the EV land grab, no doubt about it, is on. And I thought it was interesting, Katie, when you were talking to him about China specifically, Steve brought up about batteries. I mean, China, standout leader. They've got 80% share of the world's lithium-ion battery capacity, huge leads in other critical components. So it's like, how do you come up against it?
Yeah.
And that is why, you know, this land grab is going to change things very dramatically globally, because every country is kind of fighting for their position, and their companies within those countries are fighting for their position as well.
And beyond just Chinese batteries, I mean, Chinese EVs in general, you can't really get them in the U.S. And of course, I would imagine having that entire market out of the U.S. also is one thing that's decreasing competition.
But it also
here.
means, right, then European or maybe American aren't going to be able to have the same access, although Elon's done just fine. But
It's about adoption. I think it's about adoption and what you're used to. And if you look at the growth in the global EV sales for last year, 14 million, up 35%. So you're looking at really a formidable lift in the numbers. And China is where the adoption is perhaps a little bit more aggressive than it is in the United States or, in Europe.
I think price points are going to be really important. Having said that, let's check prices when it comes to how the market is setting up here at 9:30 a.m. Wall Street time, of course. Whoa, that would
You're looking forward to 9:30.
That would be a long day.
That's how long we'll be on air.
I will be napping.
Through.
I will be asleep. S&P 500 futures, folks, 48.31. We're down about 3/4 of 1 point, so that's 0.02%. All right, having said that, very, very quiet here. It's interesting, though. I love the EV space. And, talk about every time we think about a new car, I want to do an EV, but some of the price points are kind of rough. You do worry about plugging in, where you charge it. Yeah. And you talk about the range anxiety.
She's got range anxiety.
I just signed a new lease, and I have to say, anecdoted, but...
Not an EV.
EVs didn't cross my mind. I was like, where am I going to charge it?
You didn't even look.
I didn't even look. First, it's too expensive. I park my car in the city. My parking garage has one EV charger. That doesn't seem feasible at this point.
Well, you want to go and pick up yourself an SU7. We talked about this yesterday. This was the new one from Xiaomi, and it has a range of 800. I'm just looking back here.
Yes,
800 kilometers. But Carol, for you,
what?
500 miles.
Thank you very much. He's my own little converter.
You
Don't ask me for yuan to dollars. I haven't got that far yet.
You can get to New Jersey and then back, and then do that a few times with 500 miles.
I was surprised. 800 kilometers,
That's
500 miles is a lot.
I will say, though,
or maybe it's not in this country. Maybe not for the size of this country.
Is really, like our bond market, the country itself is...
We've got a big bond market.
It's like being with my 6 brothers and sisters. You can't get a word in edgewise. It's kind of rough. All right, coming up next, can't wait to talk with Angela Stent of the Brookings Institution, someone who understands Vladimir Putin so well. This is Bloomberg.
There will be a temptation to think that the three major conflict areas geopolitically that you just pointed out, Ukraine, Israel, Taiwan, are going to be somehow handled when in fact they're going to continue on for months. There's no easy end to the Ukraine war. The Israelis say that the Hamas war will go on for months, and I don't see anything there to stop it. And there's a lot of volatility around Taiwan, which I think, frankly, is underappreciated by markets.
Many serious hotspots around the world as we face 2024. That's Terry Haynes, founder of Pangea Policy. And on that, just a few hours ago, seeing a story on the Bloomberg, Russian forces hitting mostly civilian targets in Ukraine with the largest missile and drone barrage of the 22-month invasion, killing at least 18 people. This is days after Moscow blamed Kyiv for a strike on a military ship in Crimea. So a lot to talk about. Angela Stent is here with us. She's non-resident senior fellow at the Brookings Institution. She's author of Putin's World. She understands Vladimir Putin so well. She has worked, done national intelligence for Russia and Eurasia at the National Intelligence Council, so really understands a lot when it comes to geopolitics. Angela, good to have you here as we get ready to wrap up 2023. This latest barrage by Russia shows that, to you, that this war is long from over?
Oh, yes, this war is going to continue well into 2024, despite stories that occasionally appear in our media about Putin being willing to negotiate. He's defined this as an existential issue for him, the survival of his regime. And as we saw today, this was, I think, the deadliest attack, again, hitting civilian targets mercilessly, and anger that the Ukrainians were able to destroy this amphibious Russian warship in Crimea this week. This was a major gain for the Ukrainians, but still they are fighting very hard to maintain their position.
Angela, I do wonder that geopolitically there's a lot going on around the world, to say the least. It's an understatement with what's going on in the Middle East. And I do wonder how global allies are preoccupied with so much and how that might impact their support of something like the Russian war in Ukraine.
Right. So for Putin, the Israel-Hamas war has been a godsend. Attention has been diverted to what's happening in the Middle East, away from Russia, Ukraine. And then, of course, you have this debates within the United States. Our Congress couldn't agree on a major $60 billion aid package for Ukraine. They went away. They may be able to agree on it in January, but it's, of course, tied to all these issues of border security. The European Council was unable to vote on a 50 billion euro tranche of financial support for Ukraine because Viktor Orban, the Hungarian prime minister, vetoed it. They're also trying to get around this, but the Ukrainians are now saying that they cannot pay pensions going forward if they don't get this money from the European Union. So allies are distracted. They're dealing with their own domestic issues. And so the outlook for Ukraine for the next year is really very sobering.
Angela, good morning. When you talk about the lack of robust support from the US and from Europe, it is Viktor Orban, of course, who is the spoiler in that narrative. Does this embolden Putin to deliver a killing blow as he has today? I mean, it is one of the record missile barrage killing 18 people. This is breaking news this morning. He's attacked Kyiv, Lviv, Odessa are under attack. Do you think that this prevarication by the United States and by in part Europe emboldens Putin?
Oh, it certainly does. If you watch the nightly Russian TV shows, they are gloating both about the debates within Congress and the Republicans who don't want to give any more money to Ukraine, and they're gloating about a disunited European Union. Of course, it emboldens them because Putin's calculation is that if he waits this out, Western support will further erode. He is waiting for Donald Trump to be reelected next November and hoping that then U.S. support for Ukraine will...
Can I ask you if Trump... I mean, this is projection. This is projection. Yeah. But I want you to reflect on certain moments in the previous administration when Trump was in power. He went to meet Kim Jong-un. He got on planes. He sort of, grandstanded and did a great deal of theater. Is that our risk here, that if there's a shift in politics in the United States of America, is this campaign, is this Russia war going to play in the polls for Trump towards the campaign later this year?
Well, I think it will. I mean, Trump has said that he could end this war in 24 hours. I would be interested to understand how he's going to do that. But it's clearly going to play in the election campaign in the United States. The whole question of why we're supporting Ukraine and how important it is, as he said before during his presidency, to have a good relationship with Russia.
And before we get, of course, to the 2024 U.S. presidential election, we have to get through the winter. And you write in your notes that the winter will be very challenging for the Ukrainians. Walk us through that. The reality on the ground is, of course, the calendar year flips here.
Right. So the Ukrainian counteroffensive that began in June did not achieve what the Ukrainians and I think what we and the Europeans hoped it would. They were unable to take back a significant amount of territory. They need to mobilize more soldiers. Their generals have said that now. They need more U.S. weapons. And if they don't get the weapons from the U.S., which is quite possible, given the debates in Congress, it will be much more difficult for them to push back. If they don't get the financial assistance, both from the U.S. and from the European Union, again, their domestic situation, their economic situation will deteriorate. And Russia still has millions of people that it could mobilize. So far, Putin, who's running for re-election in March, has said that there won't be another mobilization, and maybe there won't be, at least until after the election. And the Russians, they've survived the sanctions. The sanctions have not had the impact that the West hoped that they would. So Russia appears to be in a stronger position now, and Ukraine really is very challenged to keep pushing back against the Russian forces.
Well, on the aid conversation, of course, on the U.S. side, we've been talking about it on the program this week, about a compromise needed when it comes to the southern border. And the expectation seems to be there that that will be achieved in January. But when it comes to the EU, you mentioned, of course, Viktor Orban's opposition. Is there a path for the EU around Hungary's veto?
I think there is, and the EU, the European Council, they're discussing this, and they've said that they hope in January that they can somehow avoid having to have, Orban vote on this and find another way of getting the money to Ukraine. But it still has been, I think, much more challenging for them. I think the other thing we should realize is that right now, the G7 countries are seriously thinking about how they can deploy the frozen Russian assets, $300 billion of them, maybe not the principal, but the interest, to help Ukraine. And this is a conversation that has now gained momentum. So that might be a way around some of this in the next year.
Hey, Angela, just got about 30 seconds left here. There is a way, though, to peace, but maybe it's after the presidential elections?
I mean, there's always a way to peace, but the question is, are the Russians interested in negotiating, and how much would the Ukrainians have to agree to give up if there were to be peace negotiations? And I think we have to be quite clear-eyed here that as long as Putin is in power, even if there were peace negotiations, they would probably only be temporary, because he has not given up his goal of trying to conquer all of Ukraine.
All right, going to leave it on that note. Angela, thank you so much. Really appreciate your insight. Angela Stent of the Brookings Institution. You know, this just kind of adds and layers on to the geopolitical that we talk about for 2024, right? This is still, 2 years in now? We're going into a third year for this war. Hard to believe. I think some initially thought this would be a quick over, if you will, but it obviously hasn't turned out that way.
This is about fatigue of the coalition, fatigue of the willing, fatigue of nations, fatigue of Europeans, fatigue of the United States of America. This is not it's tragic to say it. Sending money to Ukraine is not a vote winner in this country. It's just not. And nor is it in Europe. It's not just a
not
U.S.
Not a vote winner,
phenomenon.
but you think about when we look about geopolitically, who are our allies?
But then there's a lack of comprehension of what happens if Putin encroaches further.
Exactly.
And you do have a NATO encroachment into one of those NATO borders.
He has already, right? And there wasn't enough pushback. And so here we are talking about a war that's now going into its third year. So if he is a winner in this, then what's next?
And talking about aid, too, to Manus's point, fatigue when it comes to sending more money. We're heading into that presidential campaign. We know that U.S. voters tend to vote on domestic issues. And as Angela Stent just reminded us, winter is going to be rough here.
Well, and if you're Putin, you get along with Donald Trump. So if he's in the White House come November, maybe you wait a little bit, right? Because you know that the U.S. will play a big role in all of that. All right, coming up, everybody, we're just about 30 minutes away from the open here in the United States. Coming up next, Nancy Tengler of Laffer Tengler. She's going to join us with her thoughts on the market. She says tech names are the new defensive names. We're going to get her to explain that.
They got the balance sheets.
We think rates are going to continue to decline as the Fed normalizes policy.
I think the risk is to the downside in overplaying these Fed rate cut expectations.
We probably still get 3 to 4 rate cuts next year, but they don't start until later in the year.
It's really difficult to justify, based on the data, the hawkish rhetoric at this point.
Right now, I would be fearful because others are greedy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City, for our audience worldwide, a very good morning. It's Bloomberg Surveillance, live on Bloomberg TV and Radio. Alongside me, Massar, Katie Greifeld, I'm Manus Cranny. We've had 4 days of fun, but where have the bulls from Pamplona gone in terms of taking these equity markets higher? Ladies, what have you done to the bull run? 9 weeks of it.
They're tired. You know, it's been a long year. They've had quite a run since the end of October. We are just kind of limping to the finish.
NASDAQ 100's at 54%. You can take a couple days
You
off.
can take a breather at 24%.
You could have ended your year about a week or two ago.
I like what Sam Stovall said this morning. He said, run your longs, run your longs, run your big beasts of tech long. If you're making money on them, you may want to trade down to tier 3. And this is the best line of all. Go from NVIDIA, which is 280.
You love this.
I love this stat,
Yeah.
238%. But you want to go to tier 3. Tier 3 is Broadcom.
There you go.
Brutal.
Brutal.
Broadcom was up 100%. But this is about expanding breadth.
Yeah, exactly. And I do feel like we've heard from our guests that, yep, we still think some of the big tech names, they're going to continue their run in the new year, and maybe you shouldn't ignore them, include them in your portfolio, but give some love to some of the other names that have been ignored by the market more broadly. Although we did see some of that, certainly that uptick later here in the year.
And I was going to say, I get the concept of the rally needs to broaden, but I also think it's really interesting to get from people what they're all weather sector is. What do they think is going to outperform in almost any environment, rates up or down, economy good or bad? Most people have been saying big tech.
I know, again.
Yeah.
Just when everybody starts to say, run from it.
Let's talk about the dollar, because you've just been on a trip. And was it expensive for you? I mean, the dollar has had
London was
has its worst year since 2020, down 3%. Yeah. That's probably because you were shopping at the high end and eating in the high end and staying in the high end.
No. It was a little bit cheaper in Paris, surprisingly so, and cheaper in Prague.
No kidding.
Yeah, no kidding.
Okay, well, the Swiss
So if
franc
you're
took it away.
planning travels.
Well, there you go. Travels of the interloping surveillance team for this week. Let's talk about 2024, because our next guest is Nancy Tengler. We'll look at these equity markets. They're flat, phlegmatic, my favorite word of the week. 48.29 euro dollar. Be careful what you short. That was the message yesterday. The dollar has its worst year since 2020. Yields are ticking higher. 388. We didn't break through to the downside. There was a bit of a choking on the 7-year auction last night. Mild indigestion. Get the Gaviscon out. And oil has no sense of privilege or premium to war, up 0.5%. Amrita Sen was with us this morning. You may get to the mid-80s at a stretch and a push from Amrita Sen at Energy Aspects. Nancy Tengler is our guest, the CEO, the CIO at Laffer Tengler Investments. Nancy, good to have you with us. You put some framework around the evangelizing of the S&P 500, up 25% on the year. You said it's trading at 15 times 2024 earnings per share. Take out the FANGs, and it's at 17 times the earning. So do I just buy the index because that's a justification in of itself on a forward PE basis? Does it just make sense? Buy the index.
Well, so let me correct something. It's 15.3 times ex-FANG and 17 times with FANG in the numbers. I don't think this is a time when you want to buy the index. If you're an active manager, as we are, we provided pretty significant outperformance relative to the market, and that matters over time as you compound it. I feel like this is a stock picker's market, and I don't think I'm talking my book. I think there are companies you want to be in and companies that you don't want to be in. And our investing theme has been old economy companies that are embracing what we're calling the fourth industrial revolution. So that's digitization, AI, cloud computing, and then the suppliers of those tools to get you to that place. And I just gave a speech. I'll just tell you this real quickly. I gave a speech recently on this subject in Florida, and I just looked at companies that had embraced old economy companies, McDonald's versus Wendy's, Walmart versus Kohl's, and the relative outperformance from the companies that have embraced Walmart and McDonald's is remarkable, and we think that continues.
Well, that's really interesting. And I do wonder, some of the names that we don't necessarily talk about day to day, that are popping up on your radar. I do want to point out you are the author of Women's Guide to Successful Investing. So what does successful investing look like in 2024? You just gave us a few names and kind of strategy, other names that maybe haven't been on everybody's radar that maybe should be.
Yeah, thank you for that shout out.
You're welcome.
That's very nice, Carol. So I think one of the things I talk about in the book is having discipline, but also having perspective. And you know this as well as I do. It's time in the market versus timing the market. You early in the show, you all were talking about hedge fund performance. It has been lackluster, and it's not just this year. It's been for decades. And part of that is because of the churning. And one of the studies I cite in the book that shows that women actually make better investors, no offense, Manus, than men, is based on the fact that women tend to do more research, they tend to be more patient, and they tend to not be as competitive with the index, which ironically leads them to outperformance. And so I caution people, we're going to get some volatility in the first half of the year. We are, and it's going to be downside volatility. And that's a good thing. I mean, you need to see stocks pull back, recalibrate, but volatility is the friend of the long-term investor. And I'm going to use that myself to add to some of these high quality names that we own in our portfolio.
I think it's really interesting, the notes you shared with us ahead of this segment, that you do not believe that the Fed has to cut to be bullish about the outlook next year. Why is that?
Well, I was not only alive in the 90s, but I was managing billions of dollars. And one of the things that we've identified about 6 months ago, and I'm now hearing others talk about it, is that this market is analogous to the 1990s. So you had the 10-year yield between 5 and 7% the entire decade. Inflation was above 3% entire decade. You had an inverted yield curve, a soft landing, a war in the Middle East, a recession early on in the decade. And yet the NASDAQ was up over 800%. 4%, and the Dow and S&P were up about 440% each, approximately. You can coexist stock outperformance with higher rates, and we think that will continue, albeit with some choppiness in the first quarter.
And we definitely saw that in big tech this year, of course, coexisting with higher rates and increasingly higher rates. I wanted to talk about Amazon because going through your calls, a lot of interesting facts here, but maybe your biggest call has to do with Amazon and the potential that a dividend could be in Amazon's future. Walk us through that.
Well, so Katie, I thought maybe we'd see one from Google 2 years ago, and I was wrong. But, you know, as a classically trained investor, the first 20 years of or 15 years of Amazon existence, I didn't get it because there were no earnings. But once I began to adjust my perspective, we use relative price to sales ratio, the stock became attractive to us. And even though it's run, if you go back since the IPO, the stock is up 178,000%.
Wow.
So when you are in the right place, right, and that was May of 1997, when you were in the right place with a smart management team that knows how to pivot, that would also be Microsoft, which is up not quite as much, but materially, and or Apple, you have to step back and say, what am I missing as an investor? Why am I not in this stock? So cloud is expected to grow at 17% next year versus 13% this year. Online stores 11% versus 9% this year. Free cash flow is expected to hit $100 billion in 2026, and that's after they spend $50 billion a year in capex. So I think this is a place where you want to be, and I'm not even factoring in healthcare, which I think they're going to be dominant in, and logistics. They are now the biggest package delivery company in the world. So there's a lot to love about the stock, and you know, and the company Andy Jassy got what we call Tim Cooked. He was no Jeff Bezos, but when you look at you know, the fact that Tim Cook was no Steve Jobs, since that time, Apple's up 1,600%. So maybe being Tim Cook is a good thing. So that's what we were paying attention to. And Andy Jassy has grown into the position. He's cut costs. He's focused. He was the initiator and CEO-ish, if you can call it that, of the cloud business. So we think this company continues to outperform for a lot of reasons that I've cited.
I checked this a number of different ways. Amazon shares up 83% just about in 2023 alone. Just a fantastic run there. But let's broaden out and talk about tech more broadly, because I'm a little bit obsessed right now with the idea of an all-weather sector. You write that tech stocks, they're the new defensive names. Does that make sense when you think about, interest rates up, down, economy bad, good, that these are just your companies that are going to perform?
Yeah, Katie. So if you think about what do I want to own in a slowing economic environment, I want to own companies that can deliver reliable earnings growth. So even in the tech bear market of 2022, you had a company like ServiceNow that was delivering, 20 to 25% earnings growth. Each quarter they'd report, the stock would run up, and then everything sold off again on interest rate concerns. But these are not, the kind of companies that, in fact, higher interest rates have been good for these companies. So take a look at Microsoft. They issued all their debt at pre-pandemic levels, so their debt servicing requirements have remained flat. But the interest income on the balance sheet drove cash in the second quarter from $500 million to $900 million. So these are companies that, in a weird way, are beneficiaries of higher interest rates. So we think you want to be focused here, where the name of the game is reliable earnings growth. And last thing I'll say is, ServiceNow, Bill McDermott's a great CEO. They are taking IT spend away from others. Hock Tan at Broadcom, we call it the poor man's NVIDIA. That's been a great stock for us. So we like all of these, these first and second tier names, and you can broaden out in technology without just owning the Magnificent Seven.
And Nancy, just to round off, I'm curious, you've got two other calls in there. You've got Brookfield. We've just spent a little bit of time talking about commercial real estate, the properties in LA, taking a headline haircut. What do you like about Brookfield relative to its peers?
Well, so we first added Brookfield in our clean energy infrastructure strategy, and it was largely because they are lending to that space and they are the leader. But the management team has been very savvy, shadow banking lenders, whatever you want to call them. I think that's the new trend. They have much different requirements, regulatory requirements than the banks. And so we initiated it across our other large cap equity strategies in the past week, and we'll continue to add to it. I just think they're in the right space and they're more nimble and flexible. We own some of the big banks. We own JP Morgan and we own PNC, but we like Brookfield for the next 3 to 5 years.
Well, a formidable CEO there in Bruce. So, let's keep an eye on those calls, as you say, broaden the church. Nancy Tengler of Leffer Tengler Investments. And if you're just joining the program, this is what we've got for you on equity markets. The S&P 500 trades at 48.29 That is down 3 ticks or 0.6%. And to Nancy's point, we can live in a world where she takes us back in time, a little bit like the TARDIS, which is we go back in time, which is a world where you have higher rates and that equity markets can perform and outperform. But what a brilliant comparison between Tim Cook and Steve Jobs. You know, he's a great cost cutter, but he's no Steve Jobs.
Tim Cooked. I've never heard
Being
that.
Tim Cook.
But it's got to be hard for, right? You know, you think about an iconic company that is so identified with the company's founder. Certainly that was the case for Apple, certainly for Amazon. It's hard to kind of
Well, we had one of those founders yesterday. We had Kathy Wood.
That's true. Yeah. But I will say when it comes to Amazon, when it comes to Apple, she also makes the point that even though maybe they don't get the name recognition, the stock has done pretty fantastically.
Yeah. Nobody would argue that Apple has suffered under Tim Cook.
Yeah.
No, definitely not. But of course, it's interesting that she says the tech names are the new defensive plays. But this goes down to balance sheet. It goes down to the debt levels as well. And that's what we're going to pick up on Apple next.
I thought you were going to ask her about Broadcom. She said she's going to continue to add in her notes on weakness.
And I thought we'd already done the commercial.
You were going to go there.
No, I thought we'd go for the broader call. We'll talk about Apple a little bit more now. We're going to pick it up with Mark Gurman on the Apple story. Do you want to be long Apple going into 2024? The stock is up just under 49% for this year.
They're going to have patent issues like this on healthcare, but there's a renaissance of growth on iPhone units, services, double digits, and that's why I think a lot of the bears right now, they're deep in those caves in hibernation mode. I think a year from now, we have a $4 trillion market cap on Apple.
And that, of course, is Dan Ives, Wedbush senior equity analyst, speaking to us on Tuesday. Very bullish, talking about Apple potentially being a $4 trillion stock. A lot to talk about. I mean, Apple's had a very good year. The stock is up to, I think, just shy of 50% here in 2023. So, and a lot of stories and a lot of concerns this week in terms of litigation, stopping sales of the Apple Watch, but coming back on board. So, no offense, guys. I'd love to talk to you, but I really want to talk to Mark Gurman about it. He's Bloomberg chief correspondent, Apple expert, has written a bunch about Apple always, but also this week. Mark, good to have you here. We know it's early. I think you're on the West Coast, so it is kind of early. Talk to us about the watch specifically in terms of the back and forth, pulling it off the market, putting it back on the market. Patent litigation, I feel like when it comes to technology companies, it's a kind of a given. But how should we be thinking about it, at least for the investment side and the investor audience?
Sure. Thank you so much for having me. So I'll start off by saying that the Apple Watch, one of Apple's most premier products, being pulled from sale in the U.S., that's unprecedented. That just doesn't happen. When the ITC said in October that Apple would have to pull the watch from store shelves after a 60-day review period, that's how we ended up with this happening during the week between Christmas and New Year's. I think a lot of people believe that there would be no way Apple would get to this point. Either Apple would figure out some sort of settlement, either they would issue a software update, they would convince the Biden administration to veto the order from the Trade Commission. I think it was very surprising, including to myself, when these things actually got pulled from store shelves. Now, the ban, for all intents and purposes, really only lasted a few days because Apple, just a couple days ago, got an emergency order through an appeals court in D.C. that got them to put the watch back on the market. Now, this is temporary, right? Apple still has to put a software fix in place. or another type of fix. And that fix is being reviewed by the U.S. Customs Agency. There was actually a hearing yesterday on Thursday. We don't know how the hearing went at this point because it's all closed door stuff. But by mid-January, we should have some sort of answer from the Customs Agency whether or not the fix via software that Apple has proposed for the watch is sufficient enough to no longer, in their view, violate the patents from a company called Massimo, a medical device company, that say Apple infringed and got the ITC to pull the watch from Apple stores in the U.S.
Hey, Mark, are we naive to just assume that Apple's going to figure this one out and they'll be able to keep their watches on shelves in the future?
I think we were naive to believe that this wouldn't happen. I think we're less naive to believe that Apple's on the verge of figuring this out. There's going to be a resolution here sometime in January, I believe. If the U.S. Customs Agency accepts Apple's software fix, it's game over, right? This watch is back on sale. Massimo will go after Apple again. The two companies have been in court. They have a round 2 of their trial related to patents and trade secret theft. That's kicking off in late October of 2024. For those unfamiliar, Massimo sued Apple in 2020 over patent infringement. There was actually a trial this year. It ended in a mistrial due to a hung jury. For this type of trial, you needed all the jurors to be in agreement one way or another, but it was actually 6-1 in Apple's favor. So both Apple and Massimo lost.
So they've got history and they've got form. They've got form on that. Can we just sort of, because those legal wrangles are going to continue. If you look at the wearables part of the business, I know there's a number that Katie's keeping an eye on. The wearables is 10% of their revenue. We had Dan Ives with us a little bit earlier in the week, and he evangelized he had a $4 trillion valuation on Apple. How quickly do you think it could make that valuation? But more importantly, how important is China to that? Because again, there's regulatory sniping from the Chinese on the ownership of iPhones, and iPhones are 77% of the revenue lineup for Apple.
Yeah, I'll tell you this, you could be quite successful by constantly betting that Apple's going to be okay long term and their market cap is going to keep growing. So, I see every scenario in the book that Apple gets the $4 trillion. I'm not sure it'll be in 2024, but it will happen eventually. And it's typically a bad bet to go against Apple, right? In terms of China, there have been these reports from us and others about the government banning the iPhone and other non-Chinese made devices in certain offices and certain organizations within the country. I think it's really going to take until Apple reveals its first quarter results at the tail end of January or early February to see what revenue is like in China to get a full scope of that impact. The last revenue results that we got for Apple, that was the fourth quarter, they did okay in China. They really didn't decline much. It was pretty solid overall. The issue for us in terms of trying to determine what that means is that it only incorporated very few days of iPhone 15 sales in the overall Q4 earnings. So it's really difficult to know until Apple actually puts those numbers out, because otherwise we're just guessing.
So a lot of the time, the detractors of Apple would say the scale and the speed of radical innovation, radical product development has perhaps slowed down. What does Apple need, as it were, to get to $4 trillion? Does it need multiple refreshes, which we get, or does it need something perhaps more Damascene-esque?
That's undoubtedly true. The pace of device redesigns has slowed down to an incredible degree. If you look at the iPhone 15 Pro, sure, it has pretty great new materials. It has a very advanced processor, the first 3-nanometer chip to ship in volume in a smartphone. But if you put that thing in a case, or even if you don't put it in a case, it's going to, for the most part, look and feel almost the same as an iPhone you bought 3 or 4 years ago. But that doesn't necessarily matter. It's the ecosystem, it's the lock-in, it's the services, it's the attached products like the AirPods, the Apple Watch, the Apple TV, and others, which has really created this moat for the company that's going to help it continue to grow. And I think for 2024, you have some pretty cool products on the roadmap. The Apple Vision Pro, their first mixed reality headset, that's going to go on sale in about 1 month from now. That's not going to drive a lot of revenue for Apple, but it's probably going to add for the next two years, probably between $2 and $5 billion in annual revenue. And on a quarterly basis, that could be the difference between a couple percent growth or a couple percent decline. So that could be important in the short term, but critical in the long term. You're going to see larger iPhones in the fall. They're moving from a 6.1 inch to a 6.3 inch on the smaller phone, and from 6.7 inches to 6.9 inches on the bigger phone. Now, to your questions about China, that's very important because in China, lots of consumers are shifting to one device. Instead of having an iPad, an iPhone, a Mac, a watch, etc., a lot of people are just buying phones and they want the biggest ones that they can get their hands on. And so that 6.9-inch iPhone 16 Pro Max, that's going to be pretty important for that market.
I really don't understand the desire for a larger phone, but I want to talk about the Vision Pro a little bit. I'm sure you remember the video of when they unveiled the Vision Pro and they read out the price of it and the audience gasped. It was a viral moment. It was pretty funny. Who's going to buy these? Is this just people who love Apple enthusiasts? And are we going to see the price tag come down from several thousands of dollars?
Yeah, you're going to see software developers who want to develop for the platform. You're going to see mixed reality enthusiasts. You're going to see not the early adopters. I think the early adopters are the people who buy the new iPhones the first day or week they come out. But I think you're going to see the early adopters, right? That is an even more niche audience. I'm not expecting lines outside of Apple stores. They believe over the course of a year, they're only going to sell a couple of these at most a day in each of its retail stores, right? So this is a niche product, probably in the same spectrum as people who would buy a Mac Pro or a high-end Mac Studio. Yeah. Those are the company's most expensive Macs, right? You're talking $3,500 plus $500 in tax in the U.S.
Yeah. Not for the lighthearted or the small pocketbooks.
No.
Mark, always appreciate it. Mark is always my go-to. Is it time for me to upgrade a watch, a phone? That's who I talk to. Mark Gurman, thank you so much. Happy New Year. Bloomberg's own Mark Gurman. When it comes to Apple, a must-read here at Bloomberg.
Yep, it's definitely, as he concurs with Wedbush Securities, we can make it to the 4 trillion mark, and it sounds as if it's going to be a litigious kind of year for Apple going forward. Quick snapshot of what we've got going on. There's a little bit of a turnaround in some of these global bond yields. They're rising. Equities are flat, though. Look at that, 48.29. Euro-dollar is like a pancake, 110.56. But will the ECB be forced to cut more aggressively than the Fed? That is the debate. Global bond yields are bouncing. We'll take a look at that in just a moment. BMO Wealth Management joins the team in just a moment. This is a special edition of Bloomberg Surveillance alongside Carol Massar and Katie Greifeld. Good morning. I'm Manus Cranny. We're just moments away from the cash trading here on this last trading day of 2023. As you can see, we're just moments away. We're going to roll it over. This is where we are. Stocks can coexist in a high interest rate environment, according to Nancy Tengler. This is what we got, 48.28.5 is where we are. The market is now open. This is the cash drop. Euro-dollar trades at 110.55. The dollar's had its weakest year since 2020. The euro, of course, is the 4th best performing currency against the US Yankee this year. Yields trade at 388 as there was a little bit of indigestion on the 7-year auction last night, with the dealers getting left with a little bit more that they had anticipated. Oil is marching higher now, $72, and Rita Sen was with us. Her call is to the 80, from $80 to $85. The war premium is underappreciated and underpriced. What is moving in equities? We'll get to Abigail Doolittle. She joins the team around the desk for the opening.
Well, good morning and happy New Year to everybody. The stock that I wanted to take a look at first is one that we looked at yesterday. It's not up as much as it had been earlier on the session, in the pre-market, I should say, but I'm talking about Altice USA, up for I believe it's a 6th day in a row, something along those lines, the best month on record, up 42%. And we had talked about a report that they may be selling Cheddar to a PE firm. They did, in fact, sell Cheddar to a different firm, to Archetype. It looks like a positive for the company. In addition, we do have one analyst saying that the general activity around Patrick Drahi's European assets is also creating this stir. And right now it is up 1.7%. Fisker, the EV company, shares are soaring, up more than 10%. Their 4th quarter deliveries surged 300% sequentially. Now, these are smaller numbers, but clearly moving in the right direction. They produced on the year more than 10,000 EVs. They delivered 4,700. There's a 42% short interest on this stock, and you'll notice it is a penny stock, so a bit of a squeeze. As for some of the big names, any guesses on what the best stock of the year is and the worst?
NVIDIA.
You got it. And it's heading to its best year since, I believe, 2001 on the blowout guides that we've seen from that company.
Right?
Yeah, it's a long time.
But it's amazing that it's not a record, really?
Well, you know, it's funny that you're saying that because I thought the same thing. Yeah, in 1 year it was up more than 300%, which is pretty incredible. And that's true for a stock that I was going to look at, CrowdStrike, which is also one of the top 4 stocks. We don't have it on the board, but it's only the best year since 2020, since it was up 300% that year. But we do have Meta on the year. That is the best year. That's the best year since going public in 2013. But I did want to take a look at the 2 worst stocks because you sometimes
the year of efficiency, right?
Yeah.
Yes, year of efficiency. It seems to have paid off. But we have Enphase Energy. It's heading to its worst year since 2016, and FMC, the worst year since 1986. Now, you've heard of the dog of the Dow, the dog theory, or whatever that is. Like the worst and the best.
Those that stunk, you buy them in the new year,
Yeah,
basically?
exactly. So maybe Enphase Energy and FMC are going to be stocks to own. In fact, some are saying that Enphase Energy, it's backed by cash and low capex requirements. So
But if you
let's
ask
see.
if you ask Katie where she's going, where are you going to shop?
I'm not going to Abercrombie, but a lot of the teens are out in full force, apparently. 300% higher
She's happy
this
with
year.
that.
Yeah.
Hey, Carnival's on that list. They're in the top 10.
Are they in the top 10?
Yeah, up 131%. Number
and about.
6. We've got the CEO coming up, so
Oh,
it would be
nice.
interesting to see
Yeah.
about kind of the outlook for the new year.
Nice.
Yeah.
Okay, Abigail, thank you so much.
Happy New Year.
Sure, Happy New Year.
Enjoy wherever you are, and to you out there, enjoy wherever you are as well. Let's bring in Young-Yu Ma, CIO at BMO Wealth Management. Good to have you with us. I like the fact that you're taking a slightly contrarian view here. You talk about value equities rather than those concentrated in the mega cap companies will be the shining example of good wealth management in 2024. Just expand on that, because everybody has come on the show and they have evangelized about you still got to have Mag 7. The earnings growth will be there. They'll be over 20%. But you put this forward about value to growth. The proposition for 2024, lay it out. Young-Yu.
Yeah, it's great to be here. We don't want to exclude value, or we don't want to exclude growth in 2024, but we do like how value is positioned. We think growth, there's a lot priced into it already, and value's just been underappreciated for quite some time now. Same with small caps. And even the intersection of that small cap value is really trading at very low valuations, the type that you see almost at market bottom. So we think these areas are going to gradually be more appreciated in 2024 and have better multiples going forward. So we think the market will be relatively balanced. We don't think that growth is going to soar ahead of value. We don't think that value is going to outperform the way that growth did this year, but it's going to be more balanced. So we certainly want to take a balanced approach given how much value has been underappreciated in the past few years.
To deliver on those value trades in the Russell, this is something, Carol, that you brought up a little bit earlier in the week. We started the show on Tuesday morning. Carol made the point about the catch-up trade with the Russell 2000. What needs to be the lay of the land for that? Does it need to be this fabled soft landing, disinflationary environment with multiple rate cuts? What is it that will give the value and the Russell and the broader church the good foundation to perhaps shine?
Yeah, I think we just need more of the same. We've seen a great backdrop over the past couple of months that will help value stocks and help the rally to remain broad, which we've had and which has been very welcome. I think if we continue to see expectations for interest rates to come down in 2024, for the Fed to cut at least a few times. I don't think we need the Fed to cut 4 or 5 times or 6 times next year, but even 3 or 4 times would be extremely welcome to help some of the small cap stocks and the value stocks as well. Inflation continuing to stay low, a stable labor market where we see wage growth in excess of inflation, so we get real wage growth. I think all of these things just help the broad economy to do well and really reaches down into the mid caps and small caps and the value segments of the market.
Well, on rate cuts, we were talking to Michael Purvis of Tal back in what feels like a year ago, but I think it was just on Tuesday. He was saying that if we do actually...
Not you, Michael. It's just the week.
It's just the week. If we do actually get the magnitude of rate cuts that's priced in right now, that would actually make him less bullish on equities because 6 rate cuts means that this has gone beyond just normalization. This maybe we're talking about a downturn. Does that hold water with you when you think about what's priced in and the economic reality that it would take for that to materialize?
I think there's some truth to that. I don't think that we'll see 6 rate cuts next year. I'll be surprised if we even see 4 or 5. But I do think that what's most important is the trajectory that the Fed takes. If we do see economic softness to the degree that the Fed needs to cut 5 or 6 times, yes, that would be unwelcome. I don't think we're going to see that. We think that the elements for economic stabilization and actually reacceleration of growth into the second half look pretty good. So we don't think we're going to see that many rate cuts. We think we'll see a few, and we think that'll be enough. We think that the market will be able to digest, as it's been able to, the higher interest rates that we've had over the past year. We think that will continue, and that the trajectory is much more important than the actual number of 4, 5, or 6, that trajectory that we're going to continue to be down for the Fed in terms of the short-term rates over the next year or two is really going to be what supports the market.
Well, let's take this conversation over to the bond market and what we're expecting there. If your base case plays out, what does this mean for the Treasury market, which really has been sort of the problem child of 2023, at least when it comes to volatility?
It's been a difficult spot for traders, for a lot of investors, for trying to think about where to position and when to position. We actually think that the 10-year yield, which we key off of, is a bit low right now. We don't think that, given our scenario of economic acceleration and growth resuming in the second half of next year, supports or enables a 10-year yield to stay below 4%. So we don't think now is the best time to add duration. We actually recommended clients a few months ago adding duration when we were closer to 5% on the 10-year yield. But we think there will be a better time later in 2024 to add duration. Right now, we're seeing a little bump up in yields the past couple of days. But we think as the economy reaccelerates in the second half of the year, we're going to see yields in the 10-year back above 4%.
Above 4%. Hey, having said that, Young-Yu, 1 year ago, there were 3 calls on Wall Street, and that was sell stocks, buy U.S. Treasuries, and also buy Chinese stocks. We know that didn't play out. So how are you thinking about the year that was, and maybe how you and your team a little bit humbled? A lot of people got it wrong, so I'm not just pointing, but I'm just curious how maybe you're thinking about and maybe humbled a little bit about how the year played out.
Yeah, it was an interesting 2023. Actually, a year ago at this time, we were even then expecting a soft landing in the U.S. economy. Certainly not everything that we expected went as planned. China, as you mentioned, didn't have the type of growth that we were expecting as well. But we have been talking about a soft landing for over a year now here at BMO Wealth Management, and that's in the latter innings now. We do think that's still in place, and that the elements of a stable labor market and this recalibration to higher interest rates has been pretty well digested by the markets. And we're seeing a stable labor market, a real wage growth, and good spending in areas such as construction and infrastructure. So we think the elements are in place for the soft landing still here.
All right, so constructive and upbeat, it sounds like, for 2024. What's the one big risk, though, that is on your radar?
Well, I think the one big risk, actually, that's perhaps underappreciated right now, that the 10-year yield is back well below 4%, is that if we get a resumption of growth and acceleration of growth in the second half, that we're going to see a firming up of those longer-term yields. We could even see a bit of firming up of inflation about a year from now into the end of 2024. And I think that could leave a little bit of disappointment for where the ultimate endpoint is for the Fed in terms of rate cuts. And we think the market will be able to digest that, but we think it might take some of the enthusiasm out of the market to really have a strong rally toward the end of the year next year. But we think the backdrop now looks good. But toward the end of the year, some of the forces that had been concerning previously, we think could resume with the reacceleration of growth.
Young-Yu, thank you so much for being with us. Young-Yu Ma, of BMO Wealth Management, our guest with his outlook for 2024. 2024. We're
Is
counting
that the
down.
second person to kind of say that maybe we have to be a little bit worried about an uptick in inflation and that?
Well, he's also the risk is this, according to the House Economic View, is that core PCE could break above 3%, and that could unseat the confidence in the Federal Reserve's, certainly the market's presumption that the Federal Reserve will cut 6 times as opposed to the Fed's view on 3. But if you're just joining in the program, this is what you've got at 9:41 this morning. The S&P 500 trades at 47.85. That is up 2.5 ticks in the cash, or 0.5%. So it doesn't look as if the mega bulls have stepped in for the last day of trade. They've all left. Where do people from New York go to for their New Year's Eve vacation?
I'm going to Florida.
You're going to Florida.
That's where
She's
they
a snowbird.
A well-worn path from New York to Florida. That's my
Our
plan.
own little Katie Greifeld snowbird.
Yeah,
Who knew?
flying away.
I think the one price that we just need to check in before we go is the global bond. We talked about this monster rally in global bonds, the US bonds, German and UK. But that has turned around ever so slightly in this last trading day of the year. We were on track for one of our best record run couple of months in a number of years. UK gilts, I should say, just ticking higher. It's not a monster move, but it is just a slight unpicking of this sort of the heft and the rally that you've seen in fixed income.
Who'd have thunk we're ending in a year where both global bonds and global stocks are kind of in sync, right? We're seeing move to the upside on both, which is not, typically, right, the trade that you see. But to see that that's how we're kind of wrapping up this year is impressive and unexpected.
A gift for 60/40 portfolios, which have been through their own trials and tribulations, but definitely the last 2 months, that's been the place to be.
Well, I think the best phrase that we've heard this morning is the new quasi-active ETFs.
Yeah, passive-like.
I'm still obsessed with Tim Cooked.
Okay. Tim Cook's passive light. We've got a lot, and we've got weaponized FOMO, and we've got JOMO. We've got a lot of monikers for the team when they come back. We can explain them to John, Tom, and Lisa when they come back. We didn't break anything yet. No. And we're not going to. We're going to have a great conversation. Josh Weinstein, Carnival CEO, joins us next on the show.
The business cycle lives and dies around the consumer. And the consumer has just been surprising with spending strength throughout this expansion. Over the next year, we're still going to have a healthy consumer. We have a healthy jobs market. We are not going to get the consumer in contraction. But you're going to have a consumer that's maybe a little more moderate and maybe decides that they can wait a little bit or defer some joy instead of taking it all right now.
Lara Rain, Chief U.S. Economist at FS Investments. The consumer is alive. The consumer is strong. Quick snapshot of equities, bonds, and FX as we go into the last leg of 2023. Crude is really the only thing moving up higher at 0.7% at 72.25. Bonds tick higher, and equities are flat on the day, 47.86. But you got 25% this year for your money in equities on the S&P 500.
Not too shabby, but you know what's even done better? Shares of Carnival Corporation. They are the 7th best performer in the S&P 500, up 132% year to date. And we are delighted to have with us on this Friday Carnival's Josh Weinstein. He's President, CEO, and Chief Climate Officer, joining us here on set in New York, in town. Welcome, welcome, welcome. Almost Happy New Year.
Happy New Year to everybody. Thanks for having me.
How are you thinking about the year? I mean, you guys have had a great one in terms of a stock run. You're working on a lot of things in terms of paring down debt. Talk to us. You just reported earnings last week, some pricing power. Talk to us about the kind of the business environment.
Yeah, so the 2023, we wrapped in November, on November 30th, and the one word that we like to use as a summary is record. We had record demand, record yields, record pricing, record bookings, forward bookings, record onboard spending level. So really across the board, Our business has really thrived in 2023, and we expect much more in 2024.
It could continue because you're such a great gauge of how customers are feeling. You know, you have several brands, but you really kind of speak to, you know, the everyday U.S. consumer, if you will. You just have a great read on it. Are they continuing to spend? Are they continuing to do advanced bookings? And then once they're on their ships, Josh, continuing to spend as well?
Yeah, that is exactly what we see. You know, as a matter of fact, our Q4 was, from a pricing standpoint, the highest all year. So it's accelerating, it's not decelerating. And then when we look forward, we're actually 2/3 booked for all of 2024 already.
It's nice visibility.
It's not too bad. We're about 10 points higher than we were last year. And on top of the ticket bookings, we've actually started pulling forward onboard spend. So we have more or less about 1/3 of our onboard spend being prepaid in advance. So we have a really good amount of visibility. And those booking trends, they just haven't slowed down. You know, every quarter this year, you know, people expected it's gotta slow down. We're gonna see something. The consumer's gonna get impacted. And the fact is, with our business, we haven't seen it. It's record after record. As a matter of fact, we just ended the 2 weeks of, you know, Cyber Monday and Black Friday at more records. And it's not just coming from one brand. It's not coming from the United States. It's global. It's with our global portfolio of brands, which is really, really encouraging.
Do you think we're moving, good morning, good to meet you. Do you think we're moving from many CEOs similar to yourself that I've sat with that run global airlines and global businesses have said, we've lived through a period of revenge tourism. We were all locked up for a period of time. This is something, we had this parabolic reopening and you had a parabolic rebooking. Are we evolving into some kind of new cycle? You say there's no end in sight in this demand. So if we've ended revenge tourism, how do you describe the next evolution?
Yeah, that's a great question. So we don't think this is revenge anymore. This is not pent-up demand. It's 2 years on from when we really got back in full as a corporation. This is people who have decided what's meaningful for them. How do I want to spend my life? And experiences are what they're looking for. You know, unforgettable memories and creation with friends and family. And that's exactly what cruising has to offer.
And that's what I sat down with the Accor CEO and he said, look, I haven't got enough hotel rooms and I haven't got enough high-end staff to help me run this business, which then takes me to the cruise is the high-end hotel, but to what extent are those packages off ship and onshore, those additional spends, are they critically important to the expansion and the turnaround from the loss that you've had? Do they add incrementally or significantly?
So, I mean, when we think about our business, we're a little bit different from when you're looking at hotel companies. You know, I'm staying in a hotel in New York, and I won't tell you which one it is, but I'll tell you the service is not very good. And we've learned how to live with that as a society. It's almost a tacit acceptance. No, we should not. No. And the cruise industry, our brands did not deviate from service level. Our guests have high expectations, and we aim to exceed them. We do not close off floors. We do not shut areas down. We do not skimp on the services that we used to offer. It is full steam ahead, and that's what people expect, and that's what they're willing to pay for, and that's what we're seeing.
And let's talk a little bit about the fact that you are a global brand, of course, a global company that goes many places in the world. I don't need to tell you that the geopolitical landscape, very fraught right now, 2 hot wars, and of course, conflict in the Red Sea. Has that impacted at all where you can go? And are you seeing any inflationary pressures from some of the things that we're talking about here?
So the second question is no. We haven't seen anything of note. Obviously, we pay attention to crude prices, which is a good barometer of a lot of things. With respect to the impact on our business, we had about less than 1% of our business touching Israel in one way or another. Not necessarily home porting, but it might be one transit stop on a world cruise or something of that nature. We made changes some time ago. We actually don't have any ships transiting the Red Sea area for several months. And so obviously safety first, and we have mitigation plans should we need to adjust where those ships would be transiting. But as of now, we're we're in a watch and learn mode.
Let's also talk about your bond book, because it was interesting seeing just last week, actually, S&P coming out and upgrading Carnival, not quite back to investment grade territory, but you're getting closer.
Two notches higher.
Two notches higher. On earnings day, actually, you think back, and the chief financial officer of Carnival said that there's a real possibility that Carnival will come back to the debt markets in 2024. Where's your current thinking on that, and what would actually bring you back to the debt market?
Well, really, the only thing that would bring us back to the debt market, as far as we can see, is if there's opportunity to refinance on more favorable terms.
So lower rates.
Yeah, lower rates. We're not, or managing our maturities, but we're not looking to lever up. As a matter of fact, as you said in the intro, we've managed to cut down our debt load by about $5 billion so far. And we expect much more of that as we go forward. You know, that's priority 1, 2, and 3 when it comes to our capital structure, delever.
Hey, you know, one of the things, and it kind of ties together geopolitical, but also kind of, you know, where you're thinking about growth. Saw a story, I think it was today or in the last 24 hours, that the first domestically built ship in China getting ready to hit the high seas. But it's a joint venture. You guys are involved in this. And I think about how important China is for you guys, but also geopolitically concerns about China, its ambitions with Taiwan, and whether or not there's going to be some problems there down the road.
Sure. Well, we're very happy for the folks at the China JV. We actually unwound the JV earlier this year.
You did?
We did. So we've been providing shipbuilding expertise support for them, and we were very happy to do that. And we're
The
very
story
excited
still
for
says
them.
you guys are involved, but go ahead.
Well, that could be how we're involved
Okay.
at this point. But from our perspective, we got a portfolio of world-class brands all over the world, and that's where our focus is. You know, it's great for the cruise industry that China has opened up, and it will be opening up for international cruise companies. We're not going to be one of them that's going back in. We've got our assets where we want them. We've changed our asset strategy. We've moved ships to different brands to accommodate the change in China, and they're doing very, very well. So we'll take a wait-and-see approach on that as well.
But not a market you need to be in right now, just
No,
quickly.
it's definitely not.
All right, going to leave it there. Listen, so appreciate it. We know you're spending some time with family, but great to get you while you're in town.
My pleasure. Thanks, and Happy New Year.
Yeah,
I
same
hope the
to
New
you.
York hotel tuned in. You should be getting an upgrade.
I've had the same experience in some hotels. I don't think they have the workers.
They do not.
You got to
Do you have all the workers that you need?
We do have all the workers that we need, and I'd encourage everybody, come book a cruise before we run out of inventory for 2024 because it's going pretty fast.
Josh Weinstein, the president and CEO of Carnival, thank you so much. So appreciate it.
Appreciate it.
Josh, thank you very much. Okay, it's the closing minutes of surveillance. Don't worry, you'll have everybody back to normal on Tuesday morning, but this is what we got for you. A fairly flat set of markets for you at the moment. You can still keep equity markets on the up with higher rates, according to Nancy Tengler. There you go. A little bit of green. You got S&P 500, 47.86. We never made it to the highlights of 47.96.5.
Few hours to go.
Yeah.
Carnival shares are up 1%.
There you go. And a solid outperformance to the index, run by the man himself to my left, Josh. We've got 110.67. Will the dollar have another tortured year in 2024?
Happy almost New Year. Really fun to spend the mornings with both of you guys.
Lovely to be with you both. You out-glamorize me. There you go.
Stop.
Coming up on Bloomberg TV at 11 a.m., Torsten Schlock, the chief economist at Apollo, not in an elf costume.